It's just, I don't know what else to say. I'm bullish. He said it. He finally said it. I'm so bullish. Andy's bullish. I'm bullish. We're bullish. We're going to the top.
Rollup is my favorite.
People from all walks of life, all over the world, all over this industry, come together for the Rollup.
They're simply here. It's the golden age of crypto, guys. Get right. Let's go. Welcome to the nest.
See you on the show.
Stanley Druckenmiller is buying our bags. President Trump said, hyperliquid. Happy Thursday, guys. You're watching the Rollup live from the Tokenization Tower. It is a lovely August 20th, live from the financial capital of the world. The Tokenization Tower, the Nest, as always, powered by our friends at Plume. They're on-chain asset management products. PER is at 990. Hype is pushing all-time highs. Lighter looks like it needs a green dildo. Zcash is about at $600, and I can't feel my face. I don't know what else to tell you.
Good morning to you too, Andy.
A little bit of Bloom energy. I'm hungover. We celebrated last night, and
Man, yeah. What does that mean? If you see, Bitcoin at 72 in 2026, you're all happy. Bitcoin at 72 4 years ago felt like a nightmare. Welcome to the
bull market day one, ladies and gentlemen.
That's today.
Sensational.
Yeah. I mean, we had called the pre-bull phase. Like, if you guys were, there's people from the outside looking in that are probably like, what's a big whoop? Bitcoin's at 72, ETH is at 2,200. But if you were here and you've been here every single day, you know how big this is.
I mean, I've had people texting me like, yo, man, you were right. Like, there was only a couple people bullish on the timeline. You've been bull posting the whole, for the last, month or two. And I'm thinking to myself, I'm like, okay, maybe I'm misunderstanding how many people are still sidelined. Like, maybe we're not, maybe like our portfolio allocations are like aggressively long right now, but they just feel normal.
Well, that's because, we've been all in this industry for the last 10 years, Andy. We've been all in since we started this thing. You and I got in 2016, 2017, we went all in, and then we went all in with our business and our time, and we've been all in ever since. So yeah, guys, the portfolio allocation hasn't changed.
Let's go. Hype's about to break all-time highs on the stream. Yesterday was insane. Trump said hyperliquid. We have the CFTC meeting today. I think it's actually at 1. I thought it was at 2, but it's at 1. Hype's about to go to 74. We're, within striking distance of all-time highs while on the stream. All of these bags look incredible. I mean, Pump is on a generational run today. Per looks ready for all-time highs. I was down a large amount on Per to start the week still.
I know, we talked about it.
Still.
We talked about it.
So
the Gamma Squeeze. I mean, look, we can sit here and revel in our accomplishments over the last 24 hours.
So early, like
it's so
nothing has
early.
even happened.
I know.
People are talking about selling. I'm like, dude, it's day 2 of the bull market. Why are you selling?
Yeah, exactly. And obviously we've had an exorbitant amount of gains in the last 24 hours, which just feels incredible.
Yeah, we're probably get some pullback, and it's not always going to be like crazy like this. I mean, next week we might be, choppy and down, but
right. But now
this $3 billion in liquidations, Rob. This is inverse 10-10. Shout out Thread Guy for that tweet. That was a banger. Inverse 10-10, 10-10, but up.
Yep. And I think now this is going to kick off a ton of just more fun conversations. Like I'm excited to talk about our performance. I'm excited to talk about so many things that we only talk about in bull markets. And it feels like now the Overton window is open.
I didn't realize that we were the bullish ones. Like I just thought it was normal. Like what, you're telling me you guys aren't full port, Hype, Zek, and all the other names in some decent size that we've been talking about? Like what world have you been living in?
Yeah, I mean, have we not been talking about this like for the last 6 months since we've been?
This is such a euphoric opener right now. I'm scared. Let's keep it rolling, guys. All right, guys, we have a great show today. Markets, weather, KRWQ and Frax call in. AI Supercycle with the Circle new hire, their head of agents, and then we have an independent economist joining the show, calling in live. So broad strokes here. We also have the CFTC meeting. Edward says light $3. We've been calling this for a while. Edward, we've been talking about.
I think it's at $3 right now, right?
Lighter. Edward, we've been talking about lighter since at under $1, let alone like $1.50, and now we're at 3, and we're printing, and we're not going to stop till 10. Tom Lee's a genius, and Joseph Shalom is going to be buying the entire city of New York. Don Alt coming out of nowhere and being like, dude, 4K ETH is my target, and if we just have strength there, we're going straight to 10. Dude flipped giga bullish 2 days before and you got, so much funny little lore right now on CT. People's tweets are just like, I could just screen share for days. Yeah.
I mean, it's a fun time right now. Rising tide. I do think
Quinn's flying new highs.
Ethereum, how can you not look at the difference in execution between Michael Saylor and the likes of Tom Lee?
Shout out to Tom Lee, man.
Big shout out to Tom Lee and Joseph Shalom and Joe Lubin, these guys that have been buying all the way down, lowering their entries, taking supply off, and now ETH is outperforming hard, is it not?
Yeah, by a lot. ETH, the Unlimited, Money Machine, One Arm Bandit, Music to My Ears, Miss Gunn, great to see you. Quantum Rose, what's up? Good to have you back as well. If you guys are watching on X, we have chat on X. Shoot us a message.
ETH is outperforming Bitcoin by 10%.
Yeah.
Bitcoin's up 10%, 5.5%. Oh my goodness. Just this whole pump is running.
Everyone's still silent. I put out this tweet. I was like, it is astounding to me. That the amount of people that are sidelined on this industry's best on-chain businesses is astounding. Bro, people still don't own Hype and Lighter.
Yeah,
like you consider yourself a real cryptocurrency investor. How do you not own Hype and Lighter? And then Pump. They're not going to buy EtherFi either. That thing's going to fly.
That's the barbell right there.
They're not going to buy,
we've got like 15, 20 minutes or so before our first guest. And so we've got a lot that we want to get into to help frame what's happening, why we're pumping. And
I was waiting for lower, Ice King says. Yeah.
And where we go from here. I mean, yeah.
Guys, I just want you to know, we've been bull posting ETH on the videos with Shalom and Bitwise the last couple of weeks. And the comments have always had people being like, oh, dude, Shalom, classic bull posting ETH again. What's new there?
Dude,
like,
we had
this thing's in the gutter.
We had people commenting yesterday on our Zcash video with Mert saying that it was paid shills.
And if they just longed it 10x on perps, they'd be up like 100% today. The thing's at $600.
Oh, guys, we're trying to tell you. We're trying to tell you.
This is super euphoric vibes. I'm scared. Hype 74. Hype 74, guys. Let's go. Let's give some sounds for Hype 74.
Yeah, let's get into
all right, guys, let's get into the show. Yeah, Rob. Weather markets quick. Before we do, let me tell you about Denari building infrastructure for tokenized U.S. equities, real stocks on chain.
This is the next wave. Yes. The tokenized equities bull run hasn't even started yet. Talk about day 2 of the bull run. Denari is tokenized the entire equities market. This is just going. I mean, this is trillions that is entering the DeFi protocols. I think now I saw some requests for proposals going through Aave Horizon that they're going to be getting I could just speak euphorically about this over and over again.
Yeah. Wait, what was on Aave Horizon?
I think it was actually Securitize that had put out a proposal about listing equities, tokenized equities on Aave Horizon, which obviously is part of the thesis that these assets, these tokenized assets, are now going to flow into the DeFi protocols. That means more volume, more activity, more fees, more earnings, number go up.
That's exactly what Hype's done well, is it's just this diversification of revenue. Every time I mention crypto to normies, they roll their eyes at me. Dude, we haven't even... So... We're still in the process of convincing crypto natives to go all in, right? That's how early we are.
That's a good point.
We are all in because...
We've been here. We've been all in.
I don't know what else to do with my life, right? But the rest of the industry still needs to go all in. And then the normies need to dip their toes in. And then they need to go all in.
Yeah.
And so what's happening. We're multiple stages away from...
and I have further evidence for that. I don't know if it's in our docket for today. It was yesterday until we got nerfed, but I was watching this Joe Rogan podcast, right? Okay. Funny guys. And it's such an indicator of sentiment. It's wild. These guys are basically, yes, because they associate it with Trump and making money and this and that. And the public perception is still so negative, yet number is going up, which is formula for buying higher. It's formula for the masses of retail being sidelined and buying higher. So what you're saying, Andy, this is just more gasoline to pour on that fire. I think what you said is absolutely right. We're still in the process of getting the natives to buy in. The natives are still sidelined.
The good coins.
Absolutely. And we're going to get further segmented, but just in broad, even if you're
into Hyperliquid,
Sure. But even if you think about in unison this entire industry, the on-chain natives are still in cash. They're going to come in. Then the other people from the outside are going to have to buy higher. Yeah. And then you get sentiment to actually reverse as everyone makes money at once.
If I hear crypto's a scam one more time, Little Miss Gun, stand your ground, girl. Let's go. That's a TradFi FinTech daily viewer of the show. Absolute legend. If I could give you a hug today, I would do it. All right, guys, let's keep it rolling into the markets. We'll keep this quick. Before we do, let me tell you about Frax, our stablecoin partner, open, stable, borderless. The future of digital money. Visit Frax.com. Learn more about their FraxNet product that they just launched. It's a great product. Markets, we just talked about it. We don't even need to get into it too much. Powered by Zama, as always. The thing that's interesting is that what happened is that the long end yields of the bonds actually eased a bit, but they started to go back up. Rob has more on
We're going to talk more about this later, yeah.
So we'll talk more about this. But
let's just look at what's on the
screen.
Just
put a headline out, Rob.
Yeah.
He just put a headline out saying, guys, don't worry. We're going to be adding size to these treasury purchases, to these bond purchases.
Double. Yeah, he went on CNBC earlier today. I still want to watch that segment, but there is plenty. And Andy, we're going to get into more of this because, there's a lot of misinformation flying around. And I want to clarify something that I had said yesterday, saying that this is yield curve control. This is not yield curve control. This is just essentially refinancing the government, right? If you refinanced your house because there was a lower rate available to you today, that's exactly what you would do. You'd be bragging about it, right? And so that's what we're doing on the long end. We're shifting more of it to the short end. But what this is going to push, so this is not yield curve control, but what this could push is actually the Fed to turn on the money printer. So we haven't even seen the money printer get turned on, but by reshuffling more of the long-term debt into the short-term, it's going to push the Fed and Warsh to lower the short-term federal funds rate and then take more of their assets and buy assets to hold on their books, which is pure pure quantitative easing. So we're going to talk more about this. The curve steepening.
Is that hopium good enough
flattening.
for you guys? Did you guys hear that? Like I heard that. Sounds like a math major's dialed on macroeconomics. As always, our markets are powered by our friends at Zama. Visit Zama.org to learn about their confidential computing technology. Here's the funny thing. The bottom not in crowd will not long the first real pullback either. No, they won't. They will literally say that was just a bear market bounce.
Exactly.
And
they're going to celebrate and say, now that we've pulled back from 72 to 64, that's when we're going to all go all the way down to 48. Meanwhile, I don't think we ever touch 50s ever
ETH
again.
Needs to smash 5K early on. Are you guys going to stream the meeting at 1 p.m.? Dude, I mean,
I think we want to.
I would love to.
A guest.
I would love to. We have some guests, but I think we can still stream with them. I think they would enjoy that. I think it'd be worth it.
We've got
if not just
Sam
for like 10 or
from
15
Frax.
minutes.
Yeah.
So 1.4 trillion a year in debt payments. The limit's gone. Guess what? Buy Bitcoin. Save your wealth. Save your money. All right, guys, let's get into some of the news. Before we do, let me tell you about Near, which is also flying. One of our best clients and best sponsors of the show. Visit Near.com. I'm up like 20 bands on perps on Near.com this week. We're cooking hard. Atan was short on pump, way lower. I blew his stops out. Send it to the absolute moon. Don't let these kids go short anymore. No more perps for Atan, but if you want to trade perps, do it on Near.com. How about this aggressive take from Hasib? Pouring one out for Kyle Samani. So hyper policy. So I mean, unfortunately, we were
more aggressive than this.
We were 2 minutes away yesterday, guys. So if you guys are watching, obviously we had technical difficulties yesterday when this was going on. Basically, what happened was we had a overloading of a backup server. So we're running this whole show through data centers and warehouses, and this little, there's a whole process, Amazon and S3 and blah, blah, blah. Something happened and the stream bricked. So sorry about that. I think we should be good going forward. But in what we missed was, the God candles on our biggest positions live, which, that I'm kind of like a snowball guy. Like if it's exciting, then it snowballs. That's how it led to being out at 2 a.m. last night on a Wednesday, was one God candle. Anyhow, let's play this video because this is what we missed, and this is...
Chairman Selig authorized the first ever true Bitcoin perpetual futures contract on a CFTC registered exchange, first time. I understand that Mike is also working to bring Hyperliquid into the United States in a fully compliant and legal fashion.
Face.
Working very hard on that.
Replay the
Selig
Hyperliquid part, like,
the first
in the
ever
middle.
true
Watch
Bitcoin
his face.
perpetual
Dude, the dude is
futures
bagged up
CFTC
100%,
registered
like,
exchange, first
no way.
time.
He's got Hyperliquid
I
back.
understand
He just
that
knows that
Mike
the
is
entire
also
community
working
is
to bring
Play.
Hyperliquid
Watch his face.
into the United States in a fully compliant and legal fashion.
Can we get audio?
Working very hard on that. Chairman Selig authorized the first ever true Bitcoin perpetual futures contract on a CFTC registered exchange, first
Look at
time.
his face. Look at his
I
face.
understand
He's
that
smiling.
Mike is also working to bring Hyperliquid into the United States in a fully
blink.
compliant
Dude's 10X long on
and legal
perps on
fashion.
Hyperliquid right
Working
now.
very hard on that. Chairman Selig authorized the first ever true Bitcoin.
Oh my
Wow.
goodness. And did you see Jeff Sprecher of Intercontinental Exchange on his right was like staring out into the crowd, and then he says Hyperliquid into the US. Now keep in mind, Jeff Sprecher is the guy that called Hyperliquid bigger than the NASDAQ six
he
months
did.
ago. And
Yes.
the NASDAQ chief operating officer, I think, is standing directly to his right.
Yep.
She is there in the room as the president is talking about
yeah.
bringing her competitor into the U.S. And we don't get her facial reaction, but we do get Jeff to Trump's direct right, just looking and being like, is that right? Did he really just say that? Because now the president of the New York Stock Exchange and the Intercontinental Exchange knows that there is a new competitor entering his market.
Dude.
Absolutely insane timeline.
Could you play the video one more time, please? I don't know anyone holding XRP. Yeah, we don't like XRP here.
First ever true Bitcoin perpetual futures contract on a CFTC registered exchange, first time. I understand that Mike is also working to bring Hyperliquid into
Just
the
one more
United
time, one more
States in
time.
a fully compliant and legal fashion. It's working very hard on that. Chairman Selig authorized the first ever true Bitcoin perpetual futures contract on a CFTC registered exchange. First time. I understand that Mike is also working to bring hyper-liquid into the United States in a fully compliant and legal fashion.
You guys, Arctic, you, good to see you guys. Beef, great to see you. Oh my goodness, what a timeline. I mean, like, what else? Is there a better shill in the entire world than Hyperliquid? New type, thank you for the $10. Let's see the GTE video promo. Yes, we invested in GTE. Happily, we'll show that. We don't like XRP people. Yeah, no, we do not do XRP here. We think it's, we don't think it's worth investing.
Brad Garlinghouse was on this floor here, but obviously there's several people here. Found it also interesting that Brian Armstrong got the first word and then the president of the New York Stock Exchange. Like, you can just tell.
Yeah, shit is changing. That's so bullish. All right, let's keep it rolling. Our boy Donald, if you guys don't know his lower German guy, people give him shit for like marrying a stripper. I don't know like what her situation is or what his actual personal life is, but that's like the lore that he gets crapped on for. I think he found a nice girl and he moved and he's starting a family. Like, I think a lot of the haters, but whatever, right? Anyway, he's dialed. His stuff is dialed. Target for ETH is 4K. If we're strong there, 10K. If we're not, 4K it is. I'll probably sell halfway into the rally as usual. You guys will call me washed, rinse, and repeat. Nothing ever changed. This guy's dialed. ETH's going to 4K. I mean, it's already over halfway there. This could happen in 2026. I think it's very, very possible.
Edward said Brad Garlinghouse was invited to the White House meeting for DEI purposes. I think Edward that's an early front runner for comment of the day.
Yeah. Yep, I agree.
Let's keep rolling. I know we have our guests that are getting ready in the back. We also have this meeting that's going to go live.
Yeah, we're going to cover the meeting. In the back there, guys, could you let the guests know that we're going to do some of the CFTC meeting coverage with them as well? We could set those scenes up while we kind of keep rolling. Before we get into our next topic, let me tell you guys about one of our partners, 1inch. You may have heard of this concept of shared liquidity. Products like 1inch Aqua let you approve one wallet balance to track multiple positions at the same time across pairs, ranges, and chains. Totally different way to keep your liquidity active in more markets. If you want to learn more, check out 1inch.com/aqua. Get trading now. How about this from Daniel Chung? The funniest thing I remember from the last few years of crypto was watching crypto venture funds shit on liquid crypto funds. In reality, it was mostly a diversion tactic to get LPs to look away from outrageously inflated paper marks and virtually non-existent DPI. Today, many of those same venture funds are pivoting away from their core competencies or making full-on liquid investments inside closed-end vehicles. The golden age of liquid crypto investing is coming. I agree. Our venture portfolio is basically not really active that much anymore. And a lot of these same VCs missed Hyperliquid. They obviously missed Pump. They probably missed Lighter. They probably aren't investing in EtherFi. And they're going to be buying a lot of the stuff that we have been saying on that on-chain businesses part of the barbell from you guys higher. So this is this is your next marginal buyer, guys. It is all the large VCs who have a lot of capital and they're scared to deploy because they think it was going to be lower. But two, they missed these rounds and they've written them off and they're going to buy from us a lot higher. That's your next marginal buyer, in my opinion, in terms of like the crypto natives getting all in. It's these kind of like VCs and such.
Yeah, I don't have too much more to add except a shout out to No CSM. You guys rock. I mean, big super chat day. Much love in the chat. Had us at we don't like XRP here. That's absolutely
New type. I will throw down with you on this. Andy had me at we don't like XRP here. Thanks for the 10, man. Really appreciate it, man. I'd like to show you guys that video. So if we could please get my screen up. We actually, speaking of venture investing, I don't have too much to add here other than I think the next marginal buyer for your revenue producing on-chain businesses are VCs that completely missed the boat and invested in inflated infra slop and are now realizing the shift in the entire kind of market. And, that's where we're going. On the other hand, we did invest, I think 15 or 20K into GTE back in the day. So definitely a friend of the show. And let's watch the video. Thanks for the 20, guys.
Good morning, everybody. Wall Street has been an absolute war zone the past few days. Quantum computing stocks are crashing hard.
There's still conflicting information about what happens next.
Looks like we are, in fact, in a memory bubble. Market analysts are monitoring the situation closely as trading volumes remain steady.
Consumers are getting crushed, and the Fed is asleep at the wheel.
We have a massive, massive problem on our hands. What the fuck?
It's been an absolutely crazy day on Wall Street. Quantum advances, Iran war, situational awareness.
Wow. Dude, new type. If I knew the video was that dialed, I wouldn't have asked for the $10.
Love to see
Wow.
it. Absolutely love it.
Wow, Rumps. Honestly, if you like XRP, man, this channel's not for you. I'm sorry. If you like XRP, you're not gonna have a fun time here. We're gonna outperform you and we're gonna make fun of you. So you don't have to subscribe. For everyone else who doesn't like XRP, if you don't hold Ripple, if you're not a fan of old garbage centralized coins, smash that like button on today's stream. We really appreciate it. It means a lot. Helps us out. Helps the algorithm. XRP, if you guys hold XRP, if you like it, if you're gonna talk about it, just go somewhere else. Trust me, this is not the channel for you. No hard feelings. Truly mean that. Just go somewhere else. All love. All right, let's keep it rolling into Eleanor here. So check this out. Little inside scoop here. There was a room full of crypto people and that met with Howard Lutnick ahead of the hearing yesterday. And basically it seems like they're doing anything that they can to push clarity through. So from my perspective, this is bullish. And you know, I think that there's a chance we get a surprise passing of clarity that sends us on another God candle.
I mean,
Hot take.
I don't think that's going to happen until September, but it's possible.
But yeah, that's what I mean. It would still be a surprise. The odds on the prediction markets are really bad.
Yep. So the CFTC inaugural meeting is happening now. Looks like Hayden Adams is up there from Uniswap.
Okay. Yeah, let's go ahead and pull that up. The glow up, more like it. James, great to see you, man. I'm glad we're still long in the same bags. That lighter Robinhood fractals nuts. We like Zama. We love Zama. I bought accidentally, now it prints me money. That's okay. More XRP for me. Quantum Rose, all good. Take profits, everyone. Volatility is here. Look, you guys do your thing. Manage your own portfolio. I'm not selling on day 2 of the bull market, but that's, if that's what you want to do, that's what you can do.
Leo, let's go ahead and pull this up.
Shout out to all 75 of you guys watching live. We fucking love you guys. Thank you so much.
And can we get some audio on this in the chat as well?
Expansion in our industry. In 2003,
so this is the beginning of the hearing, right?
Contract markets
yes,
regulated by
exactly.
the CFTC. Today, there are 30 designated
yes,
contract
audio
markets
good.
with 17 pending approval. In 2023, there were 2,100 traded contracts regulated by the CFTC.
Up 10% today.
Today, there are 6,700.
Bitcoin flying, new highs.
Now, I believe that the Commodity Exchange Act, the operating system of our industry, is one of the main reasons for this burst of activity. Since the enactment of the Commodity Futures Modernization Act of 2000, Congress has charged this agency with promoting responsible innovation and fair competition. Lawmakers provided the CFTC with flexible tools to effectuate this mandate, from principles-based regulation to self-certification to exemptive authority. Importantly, Congress included the terms fair and responsible in the CFTC's mission to ensure these public goals did not come at the expense of the safety and soundness of the markets or the protection of customers. Now, we are here today not to advocate for one technology, business model, or market participant. We're here to provide practical advice to the commission.
Thanks for the jewels, eyeball.
that is rooted
Really
in
appreciate it.
real-world
Per OMG.
experiences.
Agreed. Unreal.
Good
Thanks for
policy
the
is
hiding,
informed
EDR.
policy. An informed policy comes from listening to the people who operate, use, and build these markets every day. Now that's all of you. So my job as chair is to keep us on time and on topic. And I apologize in advance.
All right, so this is
In
the
that
very beginning,
role,
like the
it
opening
requires me to
remarks,
cut off
guys.
participants.
We're going to go back and
I
forth
only
between
take a
this
small amount
and
of
our first
pleasure
two
in
guests
doing
of the
so.
show. We've got
So,
Sam from Frax.
again,
We've
I
got
commend Chairman Seelig for hosting this
one of the
timely
co-founders
and
of
relevant
a
gathering,
strong
and I'll
Korean
turn it
stablecoin.
over to him for his opening remarks.
Here we go.
Thank you, Walt.
Here goes
Good
Chairman
afternoon,
Seelig.
everyone, and welcome to the inaugural meeting of the Innovation Advisory Committee. Just following our fantastic meeting yesterday at the White House with the president, he kicked us off, and we're all so grateful for his leadership. You know, he took us back to the Oval after the meeting, and he asked me, which is the more powerful agency? Is it the SEC or the CFTC? And I don't know, looking around at you all in this room and everything that you've built and our very broad definition of commodity, you know, I told him it might be the CFTC these days, but no, I'm just kidding. But we're really
I mean,
glad
this
to
guy's
support
hype
the
bags are
transactions,
just
of course, at the
exploding
SEC, and I
after
think
yesterday.
combined, our strength is really quite voluminous. So we've assembled some of the world's greatest builders, thinkers, and entrepreneurs here in our nation's capital to engage in a series of conversations about where our financial markets are headed and what role America, in particular,
wonder if they have a mention market for this.
agency, the Commodity
Suits,
Futures
baby,
Trading
suits.
Commission, or CFTC,
Yes, sir, James.
will play in shaping that future.
Market flying.
Before
It
we
is,
get
man.
started, I'd like to take a step back and discuss why American leadership on this new frontier of finance is so important. But before I do, I must provide the standard disclaimer that the views I express today are my own as chairman and don't necessarily reflect those of the commission. For more than half a century, the CFTC has stood at the
we
center
are,
of innovation in America's
We got our
financial
guests
markets,
just about ready in
helping
the back,
ensure
so we're going
that
to bring them
innovation
up
can
in just a
flourish while
moment
markets remain fair and resilient.
as we continue to hear
President
from
Gerald
Mike
Ford
Seelig.
signed the Commodity Futures Trading Commission.
Are you looking
Act
for a
in
job, bro?
1974.
We are turning the
America's
pay with
derivatives
Robbie
markets were being
Cloges. Roll up,
transformed by
roll
an
him up and knock him
explosion of
down.
interest
Yes,
in
sir,
a wide
James.
range of novel instruments, from contracts on currencies to petroleum allocations to Ginnie Mae certificates.
All right, guys, we're going to get our
Despite
two guests
federally
up and
regulated
go back and
commodities
forth from
having
this
existed since the 20s,
stream and
prior law
also
only
talk
covered
stablecoins,
contracts on
markets, and get their
enumerated
takes.
commodities
Just give us a
like
couple
wheat,
more seconds.
corn, cotton, and rice. The balance of contracts were subject to the same patchwork of state laws that had prompted Congress to institute federal commodity laws in the first place. As a result, America was falling behind. The history of America's earliest commodity exchange, the Chicago Board of Trade, has been described as a saga of, quote, fending off countless politicians on both the state and national level, all of which seemed intent on shutting the board down, end quote. In 1848, a group of merchants established the board above a flour store to enforce a set of codes and rules for buying, weighing, and grading commodities and to arbitrate disputes among traders. By 1859, a convention emerged whereby parties who had committed to buy or sell a commodity could make or receive a payment to or from the other party based on the change in price of the commodity, instead of making or taking physical delivery. They standardized a promise, a measure of grain, a price, a date, so that a farmer hundreds of miles away could lock in her season before the first frost, and so that a miller could plan his year without relying solely on hope to make ends meet. These arrangements came to be known as futures
He's starting to talk about perps now.
The response to this innovation
This is
in the markets
this is like the
was
context set up
remarkably
to be
similar
like
what we've
buy
seen today
lighter and
in
hyperliquid now, boys.
As these early markets began to take shape, state lawmakers across the country moved to subject these exchanges to a wide range of state anti-gaming and anti-bucket shop laws. One lawmaker urged federal action, exclaiming that, quote, the grain gamblers have made the exchange building in Chicago the world's greatest gambling house. Karl Marx himself called exchanges, quote, gambling parlors where little fish are swallowed by the sharks, end quote. The same rhetoric has been used to delegitimize and undermine our markets for more than a century. But when lawmakers considered legislation to amend the Commodity
All right, let's get the guys
Exchange
up
Act
here
for the CEA
as soon as you're ready, Leo.
and codify once and for all a comprehensive federal regulatory
Yeah,
framework
let's start
for
with that
commodity
one.
exchanges, they recognized then what we know to be true today.
And just mute
Regulation
the thing
and
in
innovation
the back
must go hand in hand.
and we'll go back to it.
Without clear rules of the road, builders.
Gentlemen, thank you for your patience. I hope you enjoyed the little commentary. And obviously we have, crazy day yesterday
they're calling this day 2 of the bull market.
Sam, great to have you as well. And our lovely guest of the show, KRWQ, all over the background. Love that. Great setup, man. Thanks for joining us, man.
Yeah, of course. It's great to be here. Happy Thursday. Second day of the pump. Hard to follow Chairman Selig, but TLDR is we're flying.
Yeah, we are indeed.
I mean, Sam, maybe place to start. You spent a lot of time in DC, and we're going to get into Navin and what you guys are doing with KRWQ as well. But given that you spent a lot of time in DC, Sam, I mean, how much of a surprise is this versus the inevitable, just adoption, acceptance of this industry at the highest level of finance?
Yeah, I mean, I actually had the pleasure of having lunch with Chairman Selig back in Vegas, BTC Vegas this year, and then spoke to actually Patrick Witt last week. He was also at the conference, and I've been speaking to a lot of these guys regularly. It's great, right? Regardless of what happens with clarity, right? I think we're just essentially either locking in, this much of a pump or this much of a pump. So it's like, it's good stuff. Well, and then hopefully the macro stuff doesn't, block any of the euphoria.
Yeah, I mean, we were speaking, Sam, in the Empire State Building a couple months back, and this move was well before my prediction, and I guess miles ahead of yours. So we're both wrong here, but for good reason. So we'll see what we're still very early on. We can talk the market for a long time, but you guys are doing some really cool work together. Navin, it's your first time on the show. Would love to just get a quick introduction to what you are building in the space with KRWQ, and also just thoughts on the last 24 hours of the industry, regulatory-wise, et cetera.
For sure. So KRWQ is the first Korean won stablecoin. So we are the first to market. It was created by IQ with Frax as the stablecoin infrastructure partner. So IQ, actually, we have a long history. We launched back in 2018 in Seoul, South Korea. So we've been building in this space for a long time. We started with the first blockchain encyclopedia because our mission is building a more intelligent financial system. So started with the education component, then expanded into AI agents, which we use to manage IQ.wiki. And then from there, just this year, we've expanded into stablecoins, given both our presence in the Korean market, having launched in 2018 with people on the ground since then, listing quickly on Upbit, Bithumb, and Binance, and then also given our experience and our shared history with Frax.
Love it.
Very cool. Now, another thing that happened over the last 24 hours or so is that we're getting this reshuffling in the macro environment. And I'm just curious how that affects stablecoins broadly. Like what I think we're seeing is that, Bessent in the US is reshuffling some of the long end, absorbing some of that debt, maybe pushing it a little bit, front loading it a little bit more in the short end. Guys, feel free, Sam, maybe you can speak to what you think this is going to mean for stablecoins broadly. And then Navin, curious of how this affects maybe regional stablecoins, KBW, in particular, KRW in particular.
It was funny when I saw the Bessent announcement of buybacks of treasuries. I'm like, my mind is like token buybacks. I'm like devs saying they'll do like buyback and burn. And I'm like,
yeah,
this is the OG, OG
You
dev,
got the memo.
right? Yeah, buyback and burn. I think it's interesting because this isn't a geopolitics show, but part of we all know the reason that's going on is the kind of global economy kind of uncertainty. So assuming that has died down, I think we're in for a pretty glorious 6 to 12 months. I remember, Andy, you're right, we were thinking when the market would turn. I had kind of the realist view. I said H1 of 2027. I think you had late 2026. I think you're probably closer, assuming this isn't a fake out.
Yeah. And so when it comes to just to be a bit more specific on the kind of treasury here, I'm buying bonds that are at the long end of the yield curve, 20, 30-year government bonds. We're effectively introducing more liquidity into the system that way to kind of ease those yield curves from steepening too high and causing, other pressures in the economy. And so when it comes to like stablecoin specifically, both with what Frax is doing here, with what KRWQ is doing, obviously bullish market conditions bring a stronger demand to borrow stablecoins. So you get this kind of borrowing demand, which then leads to theoretically growth. Maybe you could just kind of like explain to us from both your perspectives with Korea and with the US here, how you guys see kind of this, what's happening with the Treasury, and then kind of the latest market moves. Are we expecting now to potentially be seeing stablecoin growth start to accelerate? What does this mean for holders, for yields? Just kind of give us a bit of a sense of what you may anticipate.
Yeah, and I'm sure Navin has some thoughts on the Korean or like non-USD market. But I think if you think of stablecoins, right, like money is three things, right? It's a store of value, medium of exchange, and unit of account, right? And obviously USD stablecoins, the unit of account is 10 out of 10. It's a USD, it's the global reserve currency and unit. There's talks how long and stuff like that, but it is right now, right? And so for savings, I think more and more people are holding stablecoins as their essentially cash equivalent. Yesterday, I think I saw something where there was a open for comment on declaring stablecoins itself, certain types, cash equivalent in financial transactions. And then as a medium of exchange, look, I think that there's a lot of things right now that people might not be seeing other than the clear outside things like RAIN and Visa cards, where everyone knows, okay, there's a lot of these things being used. There's also things a little bit lower under the kind of the iceberg. We're talking to public companies that want a full stack system to hold stablecoins for pay-ins, payouts. And in the non-USD area, I think Navin and their team is seeing a lot of stuff. And also the other thing is kind of my kind of hot take is Korea as a stock market and a crypto scene has kind of been on the slump the past few months, right? Like this year, it's actually been a little bit on the downturn. I think they've like halted their stock market more times in the past 6 months than I think in their like history. And my hot take actually is that this will bring back the kind of glorious Korea speculative markets that everyone knows like Korea is famous for, including Upbit, which is like the largest Korean exchange. They're slated to release Giwa, which is like their version of Robinhood chain, essentially, right? The Korean version. And so we've seen how successful Robinhood chain obviously has been. It's just like completely taken the industry and traders and everything by storm, and everyone loves it. My hot take is that the Korean market will go back to all-time highs on the launch of Giwa, which is like Korean Robinhood chain, essentially.
Wow. So Navin, can you talk about how KRWQ fits into this thesis? If Upbit does launch this, what is the denomination between, Korean traders that want to denominate in US dollars versus those that want to denominate in KRW, stable coins? Can you just talk to us about that split and then how you plan on penetrating that market?
Yeah, absolutely. So currently, obviously, DEX volumes are all USD. But I think what a lot of people miss outside of Korea is that the highest volumes, some of the highest volumes are in the Korean won. So in Korean won fiat. So across Upbit, Bithumb, there's huge volumes there that DeFi is not tapping into because it's completely separate, right? You can't arb between those pairs very easily. But this is one of the things that KRWQ can play a major role in. So this is something that's on the horizon. I think this is something that definitely Upbit is looking at in terms of Giwa, in terms of moving into DeFi. Obviously, we've seen the huge profits that USDC, Coinbase have made in that transition from fiat trading to USDC pairs to USDT pairs for Bitfinex. I think we're going to see a similar shift in Korea with Upbit, Bithumb. There's some dependencies with the regulatory frameworks in Korea, but there is huge money on the table in terms of that shift from fiat trading to stablecoin pairs, and KRWQ is prepared for that as the first to market.
Yes, you guys will definitely be active on the chain then.
Absolutely.
Yeah. And so let's say all of this goes according to plan. You guys do have a major foothold in market share, on this chain, and then broadly, in the Korean market as trading starts to revive itself in that market. Sam, could you talk about the value accrual thesis here? Like, how does KRWQ success end up accruing value to the Frax ecosystem?
Yeah, I mean, we've been partners since the launch. So the main thesis here actually is that there's a lot of non-USD stablecoins, and a lot of people have different opinions. Oh, they're only good for like FX conversions, or like everyone prefers to hold USD. Some of that may be true, but I think the main reason we work together to have the infrastructure provider for like KRWQ is I think it is the biggest, this again, maybe a hot take, but the biggest non-USD stablecoin opportunity, bigger than euros, bigger than all these other ones. But the important thing, as Navin was saying, is most of Korean trading is done in Korean won, which is very unique and different, right? If you go to like exchanges in LATAM and stuff, all the pairs are Tether, and Tether is king, right? Everyone just trades with Tether, but that's not the case for Korea. In fact, it is probably the biggest non-USD stablecoin opportunity in our view. And one of the things we're doing at Frax, with Frax USD, with FraxNet and our neobank infrastructure, is making sure that we're in the capital flows of new emerging assets, right? The most obvious ones, obviously, that everyone agrees with is like tokenized equity, these RWAs, right? They're going to be like the blue chip assets of like tomorrow, right? The ones yesterday are WBTC, WETH, right? All of these things that already have deep liquidity on like Uniswap, on Curve, on like classical DeFi. But currently there's this renaissance, right? On Robinhood chain, on other places, on Base, X stocks, on different networks, on Solana, all these things where these assets are where capital flows will come in and out. And I think one of the ones that's the most valuable and few people are looking at and being in the middle of is the Korean won unit. So Frax essentially does the mint redeems orchestration. There's some treasury underlying that is Frax USD, but most of it is KRW bond denominated, right? Just like a actual unit of KRWQ, right? You have to basically back it with Korean won sovereign bonds, right? The same way you do with like a USD stablecoin. But we are working together to make sure that this is pretty much the first to market, kind of the Tether of Korea, if you will, right? Because one thing I do agree on is that there won't be like 20 like KRW stablecoins, or like Brazilian real like stablecoins, or like Euro stablecoins. There's probably going to be one, maybe two, maybe three if Euro is like really big, right? And so the thing with KRWQ is it's out. It's essentially the Tether model. It works. You can actually get it. You can trade it. It's on Aerodrome. It's on Base. It's expanding quickly. Obviously, it'll be on Giwa. And then the cool thing is Frax powers the underlying infrastructure of it. And
from your perspective, on the KRWQ side, what has the experience been like working with Sam, Frax, and the team, Navin, and how have you kind of gone about launching this, and talk to us a bit about the growth and the success story here?
It's been fantastic. I mean, Sam and I have been working together for almost about 10 years. So even before, because Sam actually founded IQ. So IQ is the creators of KRWQ. And then when he launched Frax and started running over there, I took over on the IQ side, and we've been working together for a very long time. But, it's been great because one of the kind of advantages that KRWQ has over a lot of the other players in Asia is this partnership with Frax, right? So our stablecoin is fully, in terms of smart contracts and everything, it's all battle tested. We're using their infra. No one else has launched in the market. So there are other Korean won stablecoin projects. There's, POCs here and there, but there's no actual infrastructure. These guys, a lot of them have never actually deployed a stablecoin. So we have a huge edge there. And that's one of the great things that Frax has brought us. Also, in terms of, really excited about what Frax is doing in the FX space. So, for example, Frax USD, they have the yield forwarding on Curve FX Swap. So that's one of the best places to trade FX in general, but specifically KRWQ. And it's exciting having that yield going back to the LPs and really being able to grow there.
Yeah. Guys, I think we're going to get Mike Seelig, but I want to get your commentary on this because I'm curious how, in particular, Forex could evolve with like some greater market conditions. I'm curious. Obviously, there's, foreign exchange kind of happening on chain right now, but this is a massive, massive industry. Sam, from your conversations, with Seelig and Patrick Witt, how do you anticipate the Forex market will evolve as we get greater stablecoin adoption, regional stablecoin adoption? Is there any regulatory changes that you'd like to see to make this a more liquid stablecoin Forex market?
I mean, it's hard to complain with what we're seeing literally live right now in terms of
the webcast audience can hear
the guidance and everything.
If you are attending virtually,
I think that the hyperliquid trading, right, lighter trading, all of these, they're adding new assets as collateral, right? Like one of the things that would lock in, for example, a stablecoin's network effect is using, for example, KRWQ for a lot of the Korean collateral, right? Korean traders and those things, right? Same thing of how USDC is essentially used on Hyperliquid right now. It is a huge sink in utility, as well as on Lighter. Lighter's actually been pretty good at adding various types of collateral. And so I think that literally just bringing this stuff out in the open will create so much more market potential in terms of size. One of my views is like there will be like 1 to 2 billion stablecoin mints here or there as like a regular thing in 2027, whereas a $1 to $2 billion stablecoin mint literally would put the stablecoin itself in like the top 10 right now, right? I think that stuff will go into hyperdrive with all of the usage of on-chain trading.
Wow. And so you think that we're going to end up getting institutional adoption to the extent where they're printing billions of stablecoins in one shot? Like, what is the use case? What is the reason? Can you just like help to flush out this thesis a little bit more? How it might work in Korea or how it might work in the US?
Yeah, I mean, in Korea, it's kind of a little bit early to get into the 1 to 2 billion range maybe in 2027. But even for us, we've been speaking with public companies that we've signed some things with that we'll announce next quarter. But we've seen the actual demand of wanting to use stablecoins entirely in their whole pay-ins and payouts and downstream payments. And these are companies that have billions of dollars of just cash, right? The biggest of which would be like the FANG, but even going down Fortune 500 companies, they have billions of dollars in cash reserves, right? It's not crazy to think if they move 10% of the cash in a legal Genius compliant stablecoin, right? Like if they move 10% of their cash, it's like $3 billion. Their stablecoin partner, their platform that they use for like pay-ins, payouts, and their entire business will be powered by that, right? And so the main thing actually that is really interesting to me is that the more and more this happens, the less and less stablecoins even need to be redeemed in off-ramped, right? I saw I think there was the Rain CEO that said, right now 100,000 merchants accept stablecoins without knowing it, right, through Rain cards. And one of their goals is like eventually they can offer just direct stablecoin settlement on the merchant side by turning it on, and it's instant, right? And once that happens, then you all of a sudden flip on, right, 100,000 merchants, right, that will just accept the stablecoins. Now you can actually just downstream pay in stablecoins. You'll never need to actually redeem them. You don't have to have Visa's network redeem them into bank deposits, right, to actually settle with the merchant or acquirer bank, right? And so in those times, right, once all those things happen, once all of those things that need to happen are actually live, you could totally see, right, a company having 10% of, like a Fortune 500 company having 10% of its cash in stablecoins, because they can make downstream payments, they can make upstream payments, and those don't get redeemed because that company then also can make upstream and downstream payments to their supply chain. And so that is what I'm personally extremely excited about in 2027, because we're helping actually connect some of those flows. And then other people on the retail and merchant side, like Rain, are doing it at a vast, huge scale, right? 100,000 merchants. And once all of those things are actually turned on, right, you'll be able to literally use stablecoins directly without having to off-ramp every other hop of a payment, right?
I mean, is this consistent with the thesis that, a dollar on-chain tends to stay on-chain because more of the stack is on-chain, and so you don't need to go off and come back on at some of these different payment steps?
Yeah, I think that, right now, a dollar on-chain that uses Hyperliquid or Lighter almost always stays on-chain because that's what the users really want. And the question is, can everyone use Hyperliquid, Lighter, Polymarket, Kalshi, and can those larger institutions use them? Then they will also stay on-chain. And then the only thing left is the actual upstream and downstream merchants, payments, supply chain, right, and labor, right? The other thing I'm really focusing on and thinking about and trying to do research is like how much of actual labor payments, right? Like actual invoicing, right? Actual payment salaries is done in stablecoins, because you have like Deal and all of these large companies that use stablecoins now offering it directly for their monthly payments, right? I just saw Deal, for example, announced it like 4 days ago, that you can now run payroll, right, with stablecoins. And once that happens, right, you have all of these employees that have stablecoins, and then where can they spend it? Well, maybe they can now spend it in 100,000 Rain merchants, right? Then it stays everywhere, right, in that entire network without ever having to be redeemed. That's like one of the things that it'll happen very quickly, and it's like a step function. Right now, it's not really there yet, and I think in 2027 it'll definitely take a lot of people by surprise.
Love it. Anything to add there from you, Navin, here on kind of Forex, cards, spending, labor, payroll, but specifically for Korea, because it's different, right, out there than it is in the US. What changes maybe are more regional specific there from what kind of Sam highlighted when, I think Sam probably thinks about these things from like a Western perspective. What's kind of different out there?
So we got some very big news today in terms of KRWQ. We just launched KRWQ Gifts. So it's gifts.krwq.cash. And why this is relevant is because this is the first step into payments, right? So in Korea, there's not yet a regulatory framework for stablecoins. But what we've been able to do is set up a platform where people can buy Korean won gift cards. So they can start using it in real world payments. For example, everyone in my family, they're all asking me, we want some Korean skincare, so we got to make sure to keep everyone happy. So we've integrated Olive & Young, but also like Starbucks, Lotte, all the regular merchants in Korea that have gift card systems. So that's our way in, the foot in the door. But then, the payments, is going to be massive. And I think right now it's tricky, but I think it's going to flip, because the good thing about Korea is, unlike the US, it's not like, because in the US, MasterCard, Visa, these are homegrown networks. So I think there's more, buy in terms of institutionally, versus I think in Korea, there may be an opportunity to leapfrog that and go to direct payments. And actually just this week actually, we signed an MOU with Nexus, which is a Korean listed, publicly traded game developer. And they're going to be integrating KRWQ as their settlement for the One Store, which is the largest homegrown app store in Korea. So we're seeing a lot of appetite to cut out, these extra fees, cut out the FX, and increase profitability within Korea.
Attaboy. Congrats, man. Guys, we got Armstrong speaking. Would love to hear it. Can we get some audio? Guys, we'd love for you to stick around, hang out, and you guys want to, react, commentary, etc. Let's get some audio, please.
There was also, some folks are here from the venture capital space, like Chris Dixon, and he's made the point to me very clearly that they just saw a real dearth of new entrepreneurs coming in to build things and to pitch them, because if you're 22 years old and you have an idea and a dream and you want to co-found some company with your friend, you're much less likely to do it if you think you're going to be sued by the federal government within weeks of launch.
True.
And you have to go tell
Shout out Sam in 2019, starting Frax, fucking in Las Vegas. Like, oh shit.
Venture capitalist doesn't want to write a $5 million check into a startup that they know 4.5 million of that is just going to go to legal bills in the impending lawsuit. So that's why I think it's so important the approach that this agency and the new regulators, the chair here, has taken. I liked what you said in your opening comments about optimism. I mean, yeah, in America, we should have optimism about the future, and every new change can be viewed as a threat or an opportunity. And I think that's what's made America great, is being optimistic about the future, seeing these things as opportunities to go work through. So thank you for your leadership on that. So yeah, clarity would be an incredible step to getting clear federal oversight, including from the CFTC on this spot market authority. And the 50-state regime really has been that patchwork quilt, so that would struggle. Now, if for some reason, I think clarity has a great chance of passing. It seems like people got 90% of what they want on both sides, and it's good for everyone. But if for some reason it doesn't pass, I
only when he's
commend
wearing a suit.
Chair Seelig and Chair Atkins for just pushing forward with clear rules regardless. And I think that's going to be very important. So there's especially, I'll mention one final thing, which is, especially in the past, it was challenging to get the two agencies to work together. And there are certain products which sit at the intersection of the CFTC and the SEC.
Market's
things
ripping.
like equity,
Loves
perps,
it. Bitcoin loves
or KPI event contracts, like on the earnings of a company or something like that. And it's so great to see
what year is
agencies
it?
collaborating now. This whole debate in the U.S. about, is this a commodity or is it security? You know, we operate in other countries like Singapore and the UK and places where there's just one federal regulator, and this question never comes up. And so that that territorial nature that happened in the prior administration has completely evaporated, and the collaboration is just a breath of fresh air. So
yeah, it is.
He's right. He's right. I mean, I don't see.
Tyler, did you have a comment?
I don't see why the whole turf wars was always like a given. It's just nice to see people actually working together too.
Yeah. You know, I think it's like the executive branch and the judicial branch and all these checks and balances that exist in the U.S. government. They just kind of, you know, permeated or, you know, exist in all the places just to check everybody. But, you know.
It's a power struggle.
Yeah, but only if the sides are extremely power hungry, right? Like Gensler and their whole goal is to expand their power and their budget and everything. Whereas the whole point of this is to serve the people, right? These are supposed to be protecting investors, not fighting between each other to see who gets a bigger budget and who wins more cases.
You've seen one. They're all different. Some say we regulate this. Some say, what are you talking about? We don't regulate it. And some say we only regulate the marketplace and not the custody part. And of course, the custody part is where things can go really wrong. And so, and even engaging a law firm to help you navigate this morass of licensing, it's actually a specialty at law firms. It's so complicated that law firms have to have their own specific practice regarding MTLs.
This guy kind of looks like the Boggendorf
some
meme.
states you can stake on Gemini, and some you cannot. And
actually, I saw people saying like
they
wanted to buy Gemini. I think it's actually I don't think they want to sell, but it'd be a steal. I think it's valued at around under $1 billion or around $1 billion. So
what, Hyperliquid to buy them?
I don't know if it was Hyperliquid, but yeah, Hyperliquid totally could if they wanted to sell. I think it's
for the licensing and all of that.
Yeah, exactly. Take it and connect it to Hyperliquid and just make it, instead of an old school, you know, centralized exchange, make it a Hyperliquid, you know, front end with licenses, right?
Exactly.
Disintermediate trade XYZ a little bit.
Hype's flying. They must have said it.
The umbrella.
Lead shoes on and a parachute. So it's incredible to finally be able to have a conversation of how we can bring in these amazing products into the US and offer this innovation and this competition and all this value to customers here. I think that's great for America, that's great for consumers, and that's great for American businesses. So it's just great to finally be able to be playing on a level playing field. And just quickly, so much of the innovation has been stifled. Why would you come into crypto just to get sued when you can go to these exciting other industries like AI? We know historically the best companies in America came out of garages and dorm rooms. They didn't come out of the conference rooms of law firms. And so
That's a
we
bar.
need to change that. And we're finally doing that. And I think that we need to be committed to helping pass clarity. But if that can't happen, we can't delay forever. We need to pass rules and rulemaking. That's going to happen anyway. You need rulemaking. If you pass clarity, you're going to have rules if you don't pass clarity. And the question is, are we going to write rules now during this administration with these chairs, Chairman Selig and Chairman Atkins, or are we going to let these rules be written by someone else, potentially a Gary Gensler 2.0? And so it's important that we get going. Chairman Atkins showed us the way with reg crypto assets just the other day and helping projects raise capital with the proper disclosures. And all of a sudden, we just may see a Cambrian explosion of innovation when it is clear to an engineer in a college dorm room how they can actually raise money.
I've been
for
getting
their
good
project.
takes, by the way, that if clarity
Right
doesn't
now,
pass,
it's
it's
not
even
clear,
more
but what is
bullish.
clear is you have to hire a lot
So
of
like,
lawyers,
I think
spend a lot
everyone's
of
just
money.
starting to
Why would you
say
bother with
things
that
are bullish
brain
regardless
damage?
of what happens, which is the exact kind of flywheel you need for like a super cycle,
It's
right?
like, well, if it doesn't pass, well, you know, we're just going to pass pro crypto rules anyways.
Yeah, and it could be better because it's like just an SEC and CFTC.
Yeah, there's no agreement with Congress, and
easier to just apply instead of like a federal charter, like, you know, kind of like pathway or something like that. So I've been hearing good takes. It's bullish either way.
Well, gentlemen, I know we're a bit past time. I'm sure you guys are busy. It's kind of early in the day here, still on Sam's side, and not sure where you are in the world there, Navin, but just appreciate you guys joining us. Hell of a 48 hours for my portfolio, your portfolio, our portfolios, and the industry at large. Thanks for being a part of the show.
Thanks, guys. Always a pleasure.
Thank you.
Really appreciate it.
We'll see you
Cheers,
next
guys.
time. Thanks, guys.
See you.
Epic. Yeah, I mean, we'll flip back there, guys, to the Inaugural Innovation Committee. Guys, I am about to hop on a plane. I am going to Utah. I'm going to the mountains for another mountain retreat. I just got back from Argentina. I need a little bit more time
This
to
one's going
zoom
to be
out.
a little bit different, huh?
It's going to be a little warmer. I'm going to get some time to myself, zoom out a bit.
Market's a little bit different than when you took off for the last
Last time I dipped in the deep bear. This time it's bull. We got 100 people watching live. You guys are fucking amazing. Thank you so much. Let's give it up for the audience here. You guys are legends. I'll see you guys not next Monday, but the following Monday. So I'll be off for another week. I'm going out to Utah for time in the mountains, reconnect with nature, get out of the Sin City here. That's what they call this place. And at least that's what our producer Alex calls it. A little bit more time to zoom out, think about what matters in life, think about portfolio moves, business moves, you know. So we can put the innovation committee back up for a little bit more, and I think we got our next guest getting ready as well. Hype to 80 tonight. W's in the chat. If your portfolio's cooking right now, throw us a like, throw us a subscribe. W's in the chat. Let's get the video back up. Let's keep watching. We'll get our next guest up. I'm going to head out soonish. What a show today. What a 24 hours. If we can get the Inaugural Innovation Committee video back live with some audio, that would be fantastic.
So if you have thoughts on that, you mentioned Phil McBride Johnson, who's...
But Rob, I mean...
Johnson Accord, the first harmonization effort between the...
Anything?
Maybe there'll be a...
Have a good trip.
Soon, I don't know. But anyway, Mike, let's go to you. And I see Hayden's online too. We're going to... I didn't see him earlier, but we'll go after Mike to Hayden.
Mike.
Online.
All right.
Early
Hello,
OG
Mike Belcher,
guest on the Rollup.
First off, like everybody else, thank you for having this. It is a delightful change from the previous administration that wanted to do the opposite. In terms of what's happened, I mean, I think we've all seen, we talk about, MTLs, state by state, all of these things are hurdles. It really comes down to a more fundamental problem, which is just speed. Business moves at speed. It has to move at speed. AI is going to make a move at even more speed, which unfortunately probably makes this entire discussion even harder as we think about what comes in the coming years. we've heard a little bit about regulation by enforcement. And what is that? That's where you tried something, and then instead of having a regulator say like, all right,
is that the Kalshi girl
that
next
didn't
door?
work, we don't like it, we'd like you to change it
Could
this
be.
way, or
I think
guide.
she's part of the council.
Instead, you
She's
get
Brazilian.
slapped with something criminal or something severe civil penalties or whatnot. So I think the most important thing is how do you
fun in
facilitate
Utah.
speed, making decisions. I think I speak certainly for everybody here. We are perfectly happy to work with the regulators on whatever it is we have to work through. We just don't want the regulation by enforcement. It holds everything back. So quick decision making, I think, is probably really an underpinning to this. And then I also heard in the opening remarks, principle-based regulation. CFTC has a bit of this. I think it's such a better model. As we look forward, trying to define rules today for whatever is going to come tomorrow is going to be tricky.
Hell yeah, Mike.
So continuing
Great
on the
take.
principle-based, I think, is a stronger path.
And Hayden, if you could unmute.
Hi, can you hear me?
We can.
Hayden.
All right, thank you. So I'm Hayden. I'm the founder of Uniswap. We pioneered automated market making, which
pink
improves market
background.
efficiency and lowers the barrier to creating and participating in markets. I really want to start by thanking
Laptop,
Chair Selig and the
cam,
CFTC leadership
no
as a builder in the
mic.
crypto space. The difference for us with this innovation approach is really night and day. And that's what I most wanted to speak to here is, what crypto startups in the US went through. And, from the beginning, we always aim to be a good actor and follow all laws and regulations where no proactive guidance was given. And, for that, I'd say that we had, me and my company and multiple of my employees were debanked. The company received a Wells notice from the SEC after a 4-year investigation. We had a CFTC investigation resulting in a no admit, no deny settlement. We had state regulators pile on to federal investigations and kind of bring, copy pastes of those lawsuits or investigate. Or
Hayden
at least
couldn't make the
investigate.
trip to DC.
We had the regulatory vacuum that was created also led to class action lawsuits that were basically recreations of the same SEC claims. On top of that, I want to kind of throughout all this,
guys,
we were
I'm
a
signing off.
100-person
Much love.
startup, and
See
so I
you
think
guys in a
most
week or two.
startups cannot
Much
survive
love.
that. So
You
we
guys are
survived that,
legends.
but I think that
W's in
we're
the
more
chat.
like an exception
Rob's
to the
gonna crush
rule,
it. Take it from
and
here.
it was because of just like
Much
the
love.
massive adoption
Everyone
and
watching,
usage of Uniswap
thank you so much.
And some of the resources
Great
that gave
vibes.
us. But for us, it like
You
really
guys are
held us back.
legends.
And I have many personal friends who shut down their companies during that same period of time because their companies could not weather it. I also had many personal friends who were crypto founders leave the United States to build their companies outside of the US as US citizens because they didn't want to go through what we were going through. And I will say that the ones that left the US also were the ones that didn't get sued, and they were able to build faster and not have the same concerns. We were able to kind of survive, but our competitors were able to move faster, were able to build things that we were not. They were able to kind of, be a lot more aggressive in terms of their growth. I stayed in the US throughout it, despite, very frequently being recommended to leave the US because I believe in kind of the promise of this country. I believe in the value of what we're doing and, that it can be good for that what we're building is good for the world, and that ultimately, working through this within the country that I live is the right way to approach it. But I will say that that was against a lot of recommendation. And I think that a lot of people that left the US also didn't regret it and had a lot less legal issues to deal with. I think that how do we go from here? I think that we've all been saying that we really appreciate this new approach, and it is night and day for us. I think that what we have to think about now is how to kind of retain these benefits into the future, right? Which is, the current, the political kind of tides can shift and turn very quickly, as we've seen in this very positive way. And so, what we have to think about is, if we really hope that clarity passes, obviously, and that's kind of, really important for builders in the US. And if it doesn't pass, then I think that the next best approach is kind of working with regulators to create as much proactive guidance during this pro-innovation period as we can to kind of help create a longer term certainty and clarity there. So, that's mostly what I wanted to speak to. Happy to kind of speak to anything else, but really just, we need clarity, and if we don't get clarity, we need, proactive regulations. I'll also kind of mention that, even in this kind of window of very minimal regulations, we did our best to interpret and kind of do the job that ultimately was meant to be regulators, but that process itself is very expensive. You have to hire lawyers to kind of redefine from first principles how to approach every single product that you build. And so we really hope to be a partner in creating proactive rules that can help have others not have to go through what we went through. So thank you.
Yeah. Well, thank you, Hayden. One of the promises of crypto is not just the asset class that sits on top of the blockchain, but the technology that underlies it. And blockchain and tokenization that we're seeing a lot of the institutions that have long been in our markets utilizing that technology. I do want to bring them into the conversation a bit more too, because in many ways, that's the most exciting part of the market structured dialogue. Not necessarily the new asset class, which is exciting, but the technology that's going to revolutionize how markets work across the board.
Yeah, I think
so
we're going to
Brad, I want to go
hop
to you
off
next.
of the video
and then
here.
I think we have Don
Ripple,
after that.
Executive Director Brad Garlinghouse speaks. So guys, we're going to tee up our AI super cycle. You can see I got this green tinge to the frame today. We're going to be chatting with Shafu of Circle around AI agents and money. We have not abandoned, even though digital assets are outperforming the AI trade right now, there is plenty happening as we build out more agentic commerce. So we're going to hear from Shafu. He's over at Circle. He's a new hire, and he's going to be chatting about how AI agents are embracing digital assets and how they're using money. So let's play the animation, and this is going to be AI super cycle powered by Near.
Welcome back to AI Supercycle, our premier AI show, airing every single week, presented by Near. We cover the ins and outs of decentralized AI, privacy, and the future of this massive technology.
Near is the blockchain for AI and the execution of AI native apps. You can check out Near's latest AI product at near.ai. Now sit back, relax, and enjoy the show.
All right, we're live. We're here with Shafu, doing my best with the pronunciation. I think it works. This is AI Supercycle. It's powered by Near. They're our crypto AI partner. And Shafu is here talking about how AI agents are embracing money, how they're using money, what the agentic economy looks like. We had Coinbase, Brian, Armstrong talking about AI Fi. And so there's plenty happening in this space. Shafu, welcome to the show, man. Pleasure to have you.
Thanks, Robbie. Thanks for having me, dude.
Absolutely. Well, I think it's good that we start with just a little bit of an intro. You've been thinking about this space a lot, newly hired at Circle. So maybe you could just tell us a little bit about what you were up to before Circle, and then ultimately how you ended up working on AI Fi at Circle.
Yeah, dude. Long story short, I was actually an AI guy. I was a machine learning engineer for a while, but then in 2020, I fell down the crypto rabbit hole. Right, we all had that moment, like DAOs, DEXs, all that kind of stuff. So in 2020, I actually started a startup in Germany where we tokenized bonds. So we did that for a while. I'm half German. I would never start a business in Germany ever again. I'm very bearish Europe. So that's a story for another time. Then I did the decentralized stablecoin on Ethereum that I think at its peak had like $50 million in TVL. And then after that, I did smart contracts for Venice AI, Eric Voorhees' company. And then 2 years ago, I started talking to the guys at Merit Systems, decided to move to New York with one backpack, which was fun. I liked it so much I stayed. Initially at Merit, we built something completely different, but around like 8 months ago, we were in pivot mode, and we stumbled into X402, right? So X402 is this open protocol that allows you to do payments over HTTP. Which for non-technical folks, it basically allows you to pay money through APIs natively over the internet. At that point in time, 8 months ago, when we started looking into X402, there were like 1,000 X402 transactions on chain, and half of them were like Coinbase tests, like basically a test that Coinbase did. So we decided to build X402 Scan. X402 Scan is like Etherscan, but for the X402 ecosystem, which allows you to see all the transfers, all the servers that support this new agentic commerce protocol. And it kind of went viral. So we went from 1,000 to transactions to like a couple of million in a couple of days, and basically jump-started this whole agentic commerce meta that we're living in now. I started talking to Circle, a couple of weeks ago. I was always a big USDC fan in general. So I'm half German, half Egyptian. I grew up in Egypt, and I saw people like they want to desperately get access to US dollars. I have a lot of my net worth in USDC on Aave and Morpho somewhere. So big fan there. Also, talked to Jeremy there, and they're like super excited about this because the agentic commerce, it's like this whole new distribution channel for USDC to get USDC out there. I think at this point in time, 99.9% of all agentic commerce happens through USDC. So the grand vision is, it's pretty obvious to me that agents are going to spend billions of dollars on the internet, right? I'm not going to go to Amazon.com to buy a mug or something. I'm going to, hit up my Cloud Code or whatever the equivalent is in 3 years and be like, hey, buy me this. And it has access to, a bunch of USDC in the background and can do a checkout. So that's like the overall agentic commerce vision. I'm going to stop there for a sec.
Beautiful. Well, there's a lot to dig into. And Shafu, before we continue, could you put your laptop maybe on a table or something, just because it's shaking the camera a little bit? But I think you make a lot of really, really great points because these things are starting to explode, and we've seen how money on the internet is just becoming ubiquitous with money off the internet. Everything is digital. And you mentioned some of the different avenues in which we can explore these things. You mentioned X402. You mentioned some of the other ways that agents are adopting these standards. Can you speak to X402? Let's start there because obviously, we're seeing how agents are now using credit cards. Some people are choosing to give them their own wallets versus give them permission to access your, typical hot wallet. We'll talk about some of the other venues in which people can start to leverage agents and give them access to money. But let's start with X402, why you feel it's so important and how the progress with X402 is going.
Yeah, 100%. So let's just envision, a world where we currently live in. You didn't have native payments on the internet. So actually 402 is like an HTTP status code that people put in, defined 30 years ago. So that was in the HTTP spec 30 years ago, and it was never used. It was never used before just because you couldn't do it through credit cards and debit cards. So that's something that's uniquely enabled by USDC and stablecoins in general. The way it's used right now is most people use it to pay for digital goods. So just imagine you're inside Cloud Code or Cloud Desktop, and you need access to the Twitter API, or you need access to the Apollo API, or you need access to the LinkedIn API. How it will work right now is you would go to Apollo, get an API key, set up your MCP locally, and that's how you access it, which sucks because now you need an API key for every single service that you want your agent to get access to. In this X402 world, you have one unified balance, one wallet that can be a hot wallet, that can be a Circle wallet, that can be any wallet, can be a Privy wallet, whatever. And now you have access to every single paid API on the internet that supports that protocol. So the way to think about Robbie is there are two different visions for agentic commerce. One is you go into ChatGPT, you need to talk to Sam Altman and be like, hey, I want to get my API into ChatGPT. And if you don't have the cloud, or, even if you have the cloud, it'll probably take you 1 year, probably $100,000 in lawyers' fees, to get enterprise agreements, all that kind of stuff. And it's probably not going to happen, especially for the long tail of APIs. The vision that we have at Circle is this open agentic commerce vision, which is any API provider can implement these APIs and can implement X402 and these open agentic commerce protocols. And now your agent with one unified balance has access to your API. So that's the vision. Instead of like getting 100 API keys, having like 100 subscriptions, you have one unified balance and you pay for what you use.
Yeah, very cool. Okay, and so we imagine that this is going to reshape the way that we're interacting with some of these online businesses. I mean, I'm already, asking ChatGPT when, I'm looking to make a purchase, like which one should I purchase? But then I'm going and making the purchase, inputting my payment details and whatnot. And so what you're saying is that there's effectively like this hub and spoke model where now X402 becomes the standard, and that is what ends up communicating to each of these protocols. But you're still saying there's an adoption curve. If I'm hearing you correctly, it's still on each of these services. Like Amazon, for instance, has to adopt X402. Like they have to integrate X402 into their payment rails. Is that correct? And how do you go and make sure that the adoption happens at all of these service providers?
Robin, I actually spend a lot of time on like just, like BD work, forward deployed engineering work to get these API providers on board. And there are actually two ways about getting an API behind X402. There's like a native integration. So it's like, I talk to Twitter, I talk to LinkedIn, and they're like, well, we're so excited about this. We're going to integrate this natively, which is just going to take them about a little bit of like engineering cycles. The other way is you set up a dedicated X402 server. You just need one API key and you're good to go. So back at Merit, for example, we had it down to 1 hour. So I talked to one potential API provider. I think the last one I did was an obscure flower API provider in the Midwest somewhere. So that's a flower API that you can call and gets you flower delivered anywhere in the US. And they were excited about it. They don't have the engineering expertise though. So they're like, hey, here's an API key and I'm going to wrap this for you. Literally takes me 1 hour. And now your Claude Code, has access to flowers and you can send it to your wife or a girlfriend or whatever. So that's how the integration works. It's very straightforward, very simple and very fast.
Very cool. And so this is starting to become the standard for how really service providers, retailers are starting to integrate agentic payments. Maybe you can just speak to how Circle fits into this, because this is a little bit more broad, the category as a whole. How does Circle, integrate? Obviously, it becomes a better foothold for USDC market share in the agentic economy. But what is Circle's role in this? And then how does Circle monetize this from a business perspective?
Yeah, so at Circle, we have a whole agent stack. So we call that the agent stack. And the agent stack is for developers, consumers, and merchants. So this is infrastructure for merchants to put their API behind X402, for customers to call X402. So it's basically, we give your Claude Code a wallet, we give your Claude Code a public key. Now you can have access to USDC and can pay for those. And our motivation behind that, at the end of the day, is just make sure agentic commerce happens with USDC. Because if you think about it, like USDC was made for this. Like just instant settlement, no fees, in comparison to like credit card fees, all that kind of stuff. So we provide the infrastructure to make sure we get as many people on the demand side and on the supply side on this open agentic commerce.
Very cool. Okay. So it's effectively a marketplace here, supply and demand. If there's more agents that are spending, there's more demand for these services and there's more demand for agents to make these payments. We're going to end up seeing that reciprocated in the market.
Yes, it's a very, very classical two-sided marketplace. Yes.
Yeah, please go ahead.
No, go for it.
I was just going to ask, how far along are we? Do you think, it's obviously still extremely early, but when it comes to building out, the channels for agents to make these payments, how far along are we? How much more progress? What is the biggest bottleneck to integrating more on? Is it the supply side or the demand side at this point? Which one needs more focus?
Yeah, it's a great question. I think on the supply side, we're pretty good, just because it's so easy to put your API behind X402. So if you go to the Circle marketplace or to X402 scan and you type in any famous API that you can think of, there is a very high chance that there's an X402 server that supports that API. A lot of work is on the demand side. And the demand side is hard for two reasons. First of all, for non-technical people or non-crypto people, it's just a lot of work to get Claude Desktop set up, to get an MCP set up, to get a wallet set up. Like, these are people that are like, what even is a stablecoin? Right. The second challenge is on terms of the UCC side, the on-ramps. The on-ramps are just, there's still too much friction. So for example, I have a German debit card, it doesn't work here. I live in New York, most on-ramps don't work here. Not only for, but especially on the business side. So businesses getting UCC very hard. We're working very hard on this to make this easier. We have a bunch of on-ramps that are very good. But that's the biggest challenge. Like, get the demand side, get UCC in people's hands so they can play around with it. Once you get there, it's actually an amazing experience. So once you have, an MCP that supports these X402 resources, you can do amazing things. Like, you can buy things on Amazon through X402. You can buy domains through X402, and you have access to all the APIs that are out there, and it's all pay-per request. You don't have a single subscription to anything.
And what is, for someone who's a little bit less technical out there, what is the process to integrate an MCP, in particular this X402 MCP, into their Claude, Claude code or their Claude account? What is the process like?
Yeah, it's literally you go to our page, you copy a skill, you put it in your terminal or your Claude desktop or wherever your agent lives, and we'll figure it out and we'll install it for you. It's very easy to get installed.
Okay.
Okay. Yeah. Mm-hmm. The harder problem is getting UCC actually.
Okay. And so for someone who's a retail, person here and they want to make, payments online, they first need an agent, so they need to deploy some sort of like Ironclaw or OpenClaw instance?
So there are different ways. So yes, if you have your existing Claude Code set up or Codex or Cursor, then you would do it there. But actually one of the last things I built back at Merit was something called Poncho. And Poncho is Claude Code, but it's in the web. And we abstract away all the super agentic technical stuff, all the stablecoin stuff. And it's probably the easiest way for non-technical people to get a feel of this open agentic commerce vision.
You can just go to Poncho, it'll help you deploy the agent, and the agent will have MCP enabled X402 stablecoin payment access.
It already has the agent, it's just Claude Code in the background, it already has a wallet, everything, you just need to sign up.
Wow, very cool. Okay, and as far as, those who are just on, Claude or just on ChatGPT, have you or Circle considered going directly to, Anthropic or going directly to ChatGPT, OpenAI, and saying, hey, we have this service, it's battle tested, we've done the audit, we think it should come out of the box with, a ChatGPT subscription or a Claude subscription? Have you considered, approaching these businesses and starting the integration process so that they don't have to use any third-party servers?
Yes. So actually, I think 2 weeks ago, and by the way, just for context, I haven't officially joined Circle yet. That's an announcement. Obviously, I talked to the team a lot. But I know some of the people on the team, they just had a presentation with Anthropic, for example. And they were very, it's a magical moment. It's a magical moment when, and to be fair, I've been in crypto for a while now. It doesn't happen when you have that magical moment like crypto people. But yeah, once you have Claude Code set up and you buy something on Amazon through Claude Code, it's just a magical moment. It immediately clicks where it's this makes sense.
I'd imagine that Anthropic, hearing this presentation from Circle about how their agents in Claude or in these models can directly make purchases, this has got to be like light bulbs going off, because this is a revenue opportunity. Like we see in decentralized exchanges, front end fees or different, maybe just 1 basis point, 2 basis points as a fee for, going and helping to execute that transaction. I'd imagine OpenAI or Anthropic can charge, a few basis point fee on top of whatever you're, I'm buying something for $12 on Amazon. All right, $12.02, and that 2 cents goes to Anthropic. They do this across trillions of transactions every week. It's a massive potential revenue driver for these frontier model companies.
The thing that I want to avoid, Robbie, and this is basically my mission, is I want to avoid that OpenAI builds their OpenAI agentic commerce thing, or Anthropic builds their agentic commerce thing. Rather, like the vision that I have is it's one open public standard, like the open internet, but for agentic commerce. And once you've integrated it once, now OpenAI, Anthropic, or any other agent has access to your API. So,
I think that vision makes a ton of sense. And I think especially us, in this industry, like we align with that vision most. But, as these things start to get played out and, they start to reach some sort of product market fit, someone made this analogy actually recently when it came to the open weight models and the frontier models, how this starts to look like Android and Apple. Like people want the verticalized, clean UX, very convenient stack. And then on the other hand, the open weight is going to be maybe, 10% or 5% or 1% the cost. It's much, much more affordable. And it's maybe, just a little bit less intelligent. And I could understand or see an open standard for agentic commerce. That's kind of like Android. Anyone can adopt it. It's open. It's essentially free standard. But then there might be a more integrated payments stack into, directly part of the ChatGPT or the Anthropic experience. And that is kind of like the Apple experience. And people are willing to pay for that level of convenience. But maybe you can just talk about why you think it's likely or unlikely and why you think it's more important that we build out this open standard and this open experience.
Yeah, I hope it's not going to turn into a 30-70% split. I hope, like, the vision that I have is, so if you go back 30 years, you had like the AOL internet, and you had like the Mosaic open internet, right? And the open internet, like it's 100%. It's not even 99.999. It's just 100%. Like the AOL vision of the internet doesn't exist anymore, and that's good. If we lived in that world, you would have someone like Mark Zuckerberg begging AOL to host Facebook.com, which would be, which sucks. So I hope it's going to turn into that, where it's just. It's the equivalent to HTTP, which powers the global internet, but the same thing for agentic commerce. It's a native way to do payments on the internet instantaneously with basically no fees through stablecoins.
Is there any sort of applications that you're very excited about? Because what you're talking about, this open standard, this open protocol on the internet, the native way of doing these things, it implies that now we're going to see applications built on top because anyone is able to build with these native open protocols in mind. What do you think? Anything that you're particularly excited about that you think can now be built once we have this standard?
Yeah. So one thing I'm very interested in is, for example, is plan my trip. Like I'm going to Paris for a week now, right here, like. I don't know, $2,000 that I want to spend. And your agent goes off and books everything.
Yeah.
Books your flight, it books your hotel, it does a restaurant reservation. So you can do restaurant reservations through X402.
So cool.
Basically sets all of that up for
Very
you.
Cool.
So that's like one use case that I'm always thinking about that would be awesome. Right now, it's a lot of like single step thing. So it's like look up Shafu on Twitter. Or go to LinkedIn and look at the most viral LinkedIn posts about agentic commerce, stuff like that. But what I'm really excited about are these, you have this high level goal, and then your agent goes on with like this unified balance, and spends for a lot of things to make that high level gold possible.
I just saw some data come in actually as we're talking. It says AI agents have initiated 16.2 million transfers via X402 protocol over the last 30 days. Base led with 9.5 million transfers, and then Polygon with about 5.5 million. And so this is just entirely fueled by people connecting MCP servers to their agents and just using it for transactions. It's not just transactions on chain, is it? Is it entirely on chain, or eventually we are going to see X402 expanded beyond blockchain and stablecoins and into like fiat rails, or do you think this is capped by stablecoins right now?
So right now it's all stablecoins. So there are two protocols right now in open agentic commerce. So the first one is X402 that we talked about, which was originally defined by Coinbase, and then you have something called MPP. And MPP comes from Stripe Tempo paradigm. And MPP actually allows you to do the same thing, but with credit cards or debit cards. So you have that path as well, which works great for like big ticket purchases, right? So it's actually kind of funny. Like I'm European. I never owned a credit card in my life. It's kind of crazy when I say that here because people love their credit cards. Well, if you want to book a flight, you want to use your credit card because of the cashback, the credit card points. I'm actually not 100% sure how that stuff works because I've never used it. But all I know is people want to use their credit cards for big purchase items. On the other hand, for like microtransactions, digital goods, APIs, you have there is no other way around stablecoins. But hopefully, even the big ticket purchases will be made through USDC as well, just because it's lower fees, instant settlement, all the stuff we love about stablecoins.
And so tell me about how X402 is able to facilitate like restaurant reservations, because there's no stable coin transfers that are changing hands. Like, how is X402 able to facilitate this?
Yeah, so there is Resi, right? Resi is the big one here in New York that people use.
Resi and OpenTable,
Yeah, so someone basically signed an agreement with Resi and be like, hey, give me an API key, I'm going to put it behind X402. And basically you can call into that server and be like, hey, here are like $5 or 1 cent or whatever they need for a reservation. You pay that, you get a reservation back through Resi. So that's basically how it works. It's, open agentic commerce is a big word, but in the end, it's a very, very simple concept. It's you pay for APIs on the internet.
Yeah. And right now, a lot of those APIs are just like monthly subscriptions, right? But you anticipate that this is going to be per call?
Yes. So right now it's per call. So the big benefit is, hey, I need access to Apollo data, or I need access to Twitter data. You don't need to set up anything. You don't need an API key. You don't need a subscription. You don't even need to sign up anywhere. You just have access to it, and you're going to spend like 1 cent to get like Shafu zero access followers or whatever.
Yeah. Wow. This is very, very cool. Look, I'm still yet to hook this up. I think I need to go to Poncho. I need to do this. I'll just do this through the browser, sign up, and then bam, everything is integrated. And I take it I can connect my Claude account or my ChatGPT account to Poncho, and everything is integrated.
Yeah, so if you have your own agent set up, it's the MCP route. If you want the easiest way to play around with that, it's Poncho.
Very cool. Poncho.com?
It's tryponcho.com.
Tryponcho.com. All right, I'm going to try it after this. Shafu, thank you so much, man. Really appreciate it, and would love to have you back. Good luck. Have fun with Circle if you do continue there, and we will talk to you very soon as the agentic economy continues to develop.
Awesome, Robbie. Thank you for having me. Talk soon.
Absolutely. See you again soon. Thanks, Shafu.
Bye.
All right, guys. Man, I love it. That's Shafu. And he gave us quick TLDR download on everything happening in the agentic economy. I mean, you guys got the full X402 update from Shafu. So very, very cool to see. And there's plenty more movement. I wish there was a way that I could just get exposure to the upside of transactions going through X402. Because if you look at the chart, Like we said, 16.5 million transactions through X402, most of them on base, almost 10 million. I mean, this thing is up and to the right. Through August, it looks like it's starting to hockey stick, and we're just going to see more transactions that are done through X402 in particular, but also just done agentically online. So I saw a flash of the CFTC. Let's go ahead and bring up the CFTC innovation meeting once again. We're going to hear a little bit more from this, and then we're going to cover some more tweets. So whenever we're ready, let's get the title ready and bring up the CFTC Innovation Advisory Committee one more time. And we're going to hear a little bit more as this meeting continues. As far as I understand, the market is reacting extremely positively to this. Let's go ahead, bring it up.
The underlying product, not the delivery mechanism, i.e. tokenization. Think about making sure that these are all risk appropriate and making sure that we coordinate on capital regulation. Margin haircut methodology and cross-border regulation. Rules have been written. It was noted earlier. We have MiCA. We have rules all over the world. Bringing your leadership together, coordinating that internationally is also important. And then there's the importance of legal certainty and netting, making sure that that works. Thinking about how we have the opportunity with tokenization to move assets quicker, to settle them quicker, to clear them quicker. But we can't forget about the efficiency offered by netting. And I think Frank has mentioned there's not enough capital in the world, cash in the world to settle growth. So we want to make sure that we think about this in the most efficient way. On the 24/7 risk management, coordinating an ecosystem-wide transition, i.e. making sure that clearing and risk management keeps up with trading, we think is critically important. Making sure that we have the funding and clearing rules very well established around margin treatment and delivery. Good sound risk management default mechanisms around some of the new infrastructures, whether it's going to be auto liquidation, how retail versus institutional is treated. And then, of course, maintaining AML and KYC rules that we have today that are applied broadly. Those have to be adhered to as well. So a lot to do. Greatly appreciate your enthusiasm and interest in solving these problems. Thank you.
Great. Let's turn to Sergey.
Great, thank you. Firstly, I'd like to thank you for creating clarity and fairness in the financial markets. I think that's a cornerstone of America's success and one of the reasons so many people build so many great applications in the American financial system. I think we shouldn't lose sight of that. That your two agencies, the SEC and the CFTC, are finally working together productively rather than fighting with each other publicly, I think is in and of itself a massive improvement, both for the reputation of the US, the trust in the markets, and obviously all the outcomes that you come together with a single unified vision instead of 16 different regulations over here and 25 over there that all conflict. And then that American innovation thing doesn't happen, which none of us want because we all live here, right? Now, we had Chainlink power thousands of applications. We power the majority of DeFi.
From the tokenization supercycle
and
clarity
I've seen
as well.
Hundreds of people decide not to build applications in the US. So for every Hayden or Shane who have the strength and the will to stay in the US and build innovative, high-quality applications in the US system and for the US consumer, there's thousands for each one of them that left, closed it down, and I know that personally because I'm their infrastructure provider for data, cross-chain, everything else beyond and in between. So that's a very serious cost, in my opinion, and I've personally been living that cost with those founders for now well over 7 years. And a lot of them, they're just not here to speak today because they're not doing this anymore, right? And they're not benefiting the financial system or the American consumer. It's a very, very serious issue, and I'm very thrilled that we're addressing it. Now, the thing that I think is going to happen next is extremely clear. The tokenization of equities is going to create a lot of on-chain value. And historically, how this industry works is when value appears, the corresponding markets and financial products appear around that value. Now, the US equities market are the majority of the global financial system's equity, value and flow right now. And if the global financial system moves on chain, well, then you would want the US financial system to move on chain at the same speed or ideally faster if you want to retain that 60% approximate market share, right? So this is really, I think, what we're discussing, and it's very important because it determines America's global position in the global financial system. And just to point out, two key things that we've been discussing here, collateral management is massively improved. On a very basic level, you go from 21/5 to 24/7, and you reduce risk massively because there's much more transparency about what's going on with that collateral. It's a no-brainer. Anyone can do the math there, 21/5 to 24/7, right? That's already valuable. That's huge amounts of value. And then to the point that was raised from the CFTC about security, that is a massively improved aspect of private key security, blockchains, smart contracts. That is, I think, going to be increasingly valuable as AI decides to attack financial markets and to try to manipulate financial markets. And I think blockchains and smart contracts and oracles are going to be uniquely capable in withstanding those cyber risk threats, which I'm more than happy to speak with you and any market participants about. So thank you very much, and I think we'll all make a great new financial system together. Thank you.
Thank you, Sergey. Vladimir, let's go.
Vlad of Lighter.
It's the face.
Here we go.
Yeah.
Thanks so much. I'm Vlad Nowakowski, founder and CEO of Lighter. We've been building in the U.S. from day one, and so it's been great to contribute to American innovation as part of this group here. We really appreciate the chairman's leadership in putting this group together and doing that. So I guess the point I want to make is, as builders in DeFi, I think there's been for a long time kind of a misconception about DeFi, and from our perspective, DeFi is not a regulator's enemy. In fact, it should be a regulator's friend. Having transactions on a ledger in a verifiable way, it actually makes it a lot easier to do the kinds of tasks that a regulator needs to do in terms of transparency, in terms of consumer protection, in terms of fairness. And so we've been very encouraged by the leadership and the staff at CFTC to really understand DeFi and understand how it's consistent with the CFTC core principles. I'll give you an example, like what's been the most robust payment system invented? It's probably Bitcoin, right? And why is that? Because it's verifiable, because it's open source. If there's a problem with it, anyone in the world, the good guys will find that problem before the bad guys, and things will get patched up. And so with that said, I think as we think about the technology going forward, the financial infrastructure of the U.S. in the future, I think decentralized verifiable finance is a big part of that as it relates to cybersecurity and operational resilience as well. Having more and more technology evolve to an open source verifiable stack will be important. And even I think a couple of folks raised the question of ADL. We would argue that even that functionality, as long as it's done in a way that's fair, transparent, verifiable, can be consistent with core principles and protect the consumer. So anyway, great to be part of this discussion. I know everyone is waiting for the break, but I'll leave it with that. Thank you.
Well, thank you, Vladimir, for wrapping that up. This does conclude our discussion on the evolution of the regulatory framework for crypto. We're going to take a 10-minute break.
AI and prediction markets
coming
up.
Pretty
fantastic here from both
dive
Sergey
into
and
our
Vlad
AI
there at the
and
end.
prediction market discussion. Thank
These
you.
guys are, they're leading this. They're leading the charge here. So that's where we're at. This. And you heard Sergey say this in particular, that they are quite literally creating the financial system as we speak. Like, these guys are all in a room. You see the biggest and brightest minds. There are incumbents in this room, but there's also the innovators. It is the Innovation Advisory Committee. And so the CFTC is now embracing that we are evolving the financial system. And you heard them speak to a piece of legislation that was signed into law recently, speaking about the Modernization Act of the CFTC. And so with that happening, they are taking that, they're ingesting it, and they are quite literally upgrading the financial system as we speak. And, sometimes there's a lot of comedy jokes about, the shadow, cabals and, the hidden hand and the blob and the deep state, controlling the financial system. But this is happening in broad daylight. This is in public. These are the people that are not only the innovators, they're also the incumbents. They're people that control the financial system right now, and the people that are on the next stage of the financial system, and they're all in a room talking, and they're live streaming it for us all to watch. So if you're curious at all about how to get involved, how to be part of the inner circle, how to be part of those who deploy and decide, make the decisions for our next financial system, this is it. This is just get in this room. And this is where the choices are being made and the new financial system is being designed. So, I mean, just figure out a way to get in this room, talk to these people, get as close as possible, and you will ultimately understand how this world works and how we will continue to progress and evolve this financial system. All right, guys, while the CFTC is on a bit of a break, we're going to hit a few of our tweets, and we've got our final guest coming up in just a few minutes. We're going to get Quinn up here in a little bit. But first, we want to cover a few tweets with you guys. So we should get a little bit of a title change. Paging our intern, title change. There we go. And let's hit, we've got Eleanor, who has been covering this. I mean, absolutely been, on the ball when it comes to this kind of stuff. Covering the Clarity Act, and then, covering everything that's happening with the CFTC today, the White House meeting yesterday, and also speaking to a meeting that occurred yesterday between Commerce Secretary Howard Lutnick, along with a lot of the executives that were also part of the White House meeting. You guys saw, Brian Armstrong, Sergey, Robin Hood's Vlad, all up there shaking hands with President Trump. Apparently there was a meeting with Commerce Secretary Lutnick before the conference with Trump. And so in the room, Brian Armstrong, Chris Dixon, Brad Garlinghouse, and Arjun from Kraken, conversation focused broadly on the importance of passing the Clarity Act and what it could mean for U.S. jobs, economic growth, and bringing crypto entrepreneurs and companies back on shore. It's funny to hear them talk about jobs only because you guys know crypto, you've seen it, if you've been here, you know that these are some of the most efficient companies on planet Earth in the history of the world. These are businesses that are generating so much revenue per employee. It's never been seen before ever. And so I don't know if I'd really focus on the amount of job creation that the Clarity Act could provide. But I do think when it comes to economic growth, onshoring a lot of entrepreneurship and companies, this is where I think we could focus and see a ton of value created on America's shores so that it doesn't go offshore and end up elsewhere. Obviously, this means tax revenue for the IRS onshore in the US, but it doesn't necessarily mean job creation. This is one thing that I would, make clear if I were, Eleanor in these meetings. Scroll down a little bit, and the group also discussed the remaining hurdles to passage of the Clarity Act, including ethics. This has been a major sticking point, and how the White House could help find a path to bipartisan agreement. Obviously, we've seen how controversial Trump has been. I think public sentiment is still that he is profiting off of crypto and his meme coin. And despite this being legal right now, this is still very gray, shady behavior. And so I don't know how involved, obviously Trump and his involvement is helping to legitimize the industry. The regulation from the SEC and the CFTC is helping to legitimize the industry. And then obviously we've seen what has transpired in the macro environment over the last couple of days. But when it comes to the Clarity Act in particular, unless Trump is saying that he is giving back some of that money, or he's saying that, look, there are going to be stricter rules and regulations around this industry, I don't know how much his involvement is really going to push forward the ethics conversation, because his meme coin is at the center of the ethics violations, and that's what we're trying to protect against. So obviously, there needs to be some involvement. He's ultimately going to need to sign this act in order for it to get put into law, but I don't know how important or positive of an influence his involvement is with ethics in particular. So we're continuing to monitor this. At the very least, it's very positive to see the CFTC host these innovation advisory meetings. And I imagine that we're going to see more positive movement and progress out of the CFTC and the SEC with reg crypto assets and greater regulation. Whether Crypto Clarity Act passes, regardless of that, we're going to see this continue to move forward. And I think that is going to continue to push the industry to new heights. Let's keep moving. I mean, market is ripping as we're talking about this. Let's continue. You guys saw what happened. This was on the heels of Bessent and him, making this Treasury announcement, which he went on CNBC today and talked about how this might get even more aggressive in terms of the Treasury buybacks and the liquidity supply that he is talking about doing on the long end. And we're going to be talking a little bit more about this as we continue here. Almost $3 billion in shorts got liquidated over the last 24 hours. This is quite literally the largest shorts blowout of all time. Absolutely insane behavior happening. I mean, you guys saw how constrained we were trading in this range, this like $63,000, $64,000 range on Bitcoin for so long. It was like the coil, the springs got so compressed, we couldn't retain this level or this lack of volatility for much longer. We knew that this spring was going to burst in one direction or the other. We were unsure of whether this was going to push us down under 50K, push the new lows, the last shakeout, if you will, that everyone was calling for. But obviously you guys have been following. You saw that we were bullish this entire time, and it wasn't if, it was just when this thing burst, and it was like the beach ball underwater. We ultimately did break upwards, and that is what we're continuing to see. And so, we knew that this volatility was going to have to return at some point. It returned, and it established the trend upwards higher, and we're continuing to see that. I mean, what timing too. I mean, impeccable timing for the conference at the White House and the CFTC advisory meeting to happen just hours after this liquidity supply Treasury announcement. As of yesterday, this was a perfect storm to break the volatility and break it upwards. And now we have a defined trend. I think everyone is comfortable calling this at least a short-term bottom. I mean, that is what we're seeing. There will be pullbacks, but we're firmly in the pre-bull market phase as the liquidity does get injected into the monetary supply. And we're going to talk about, what this could mean going forward with buybacks, with the Treasury, with the Fed. Man, this is, this feels good. It feels good. Let's continue. We've got a little bit more macro that we want to talk about because this is important to the thesis. And, we will get back to regularly scheduled programming as it now starts to shift into like this bull market phase. Conversations will shift. We'll start talking about pullbacks. Do you want to buy the dip? What is going to outperform? We're no longer talking about capital preservation. Everyone's going to be looking for the greatest amount of appreciation as we get into this phase of the market. What are the sectors to watch? Who are the outperformers? Where's the relative strength? We've continued to hammer some of the sectors that we believe are in a super cycle: stablecoins, perpetuals, prediction markets, and tokenization. These are the things, and you can put vaults in there as well. But a lot of this hinges on macro. And so I just want to clarify a couple of things that have gotten tossed around over the last couple of days, because this is pretty important to the thesis. As we start to zoom in more, we want to keep an eye on the macro landscape. But it's important to clarify some misconceptions because, especially in this corner of the internet, especially as we start to talk above our skis here, we want to bring people back to reality. What we're talking about here, the Treasury announcement as of yesterday, this is not yield curve control. Okay, this is not quantitative easing. Okay, this is not some of the other things that you've seen turn around. The money printer isn't even on yet. Okay, and so we're going to see some of these things develop. All right, but this is important to understand about where we are in the market cycle and to understand how early we still truly are. Right, because if you don't understand what's happening around us, it's a little bit easy to see we're not going to get another CFTC advisory meeting for a while. Trump's not going to be shaking hands, with the CEOs of on-chain businesses for a while, right? This might look like a local top, but once you start to understand the bigger picture, I think you'll start to realize that this is sort of the end of the beginning rather than the beginning of the end. And we're starting to transition into, more of that pre-bull phase further along, and also the bull phase that we inevitably want to see. So a couple of labels here. QE is Federal Reserve purchases of long-term assets, regardless of yield paid for with bank reserves, and both increase bank reserves and decrease duration in the private sector. We have not seen this yet. There is speculation that we'll get into about, Bessent buying the long end of the yield curve low and selling the short end of the yield curve at a premium. If Bessent is selling the short end of the yield curve at a premium, and there are not individuals, sovereigns, or buyers for the short end of the curve, and he needs to sell that, the Fed could come in and buy the short end of the curve, and that would be the definition of quantitative easing, would be the purchase of long-term assets regardless of yield paid for with bank reserves. These would be Treasury bills, etc., that Bessent would sell, okay? Yield curve control is similar, but only buys bonds when the rate is at the cap level, duration is removed, and reserves increase when the cap is hit. We have not seen that quite yet. There are repurchases that are happening, but this is different from yield curve control. We'll get into that in just a minute. The Fed twist is when the Fed buys duration and sells short-term bonds. It reduces duration held by the private sector and is reserves neutral. Treasury actions to change the composition of the Treasury's outstanding via issuance amount changes or buyback changes are a twist and impact duration held by the private sector. That is sort of what's happening now. Okay, there's Treasury actions being taken, but we have not seen true yield curve control. Okay, we're just getting our definitions in order so that we can talk intelligently about the macro climate right now. Fed providing repo programs to bond buyers doesn't change what assets the private sector holds, but increases bank reserves. This is liquidity positive and reduces the need for certain distressed Treasury holders from forced liquidation, so is supportive of long-term bonds. This is ultimately sort of like a bailout, right? These repo programs, right? Like the bank funding program, the BTFP. We saw that when some of these banks were starting to show cracks and potentially be insolvent, the Fed provided repo programs for them to take in duration and give them cash, right? And that is when the Fed becomes a buyer, it increases the bank reserves and reduces the need for those distressed businesses to become liquidated of their long-term bonds. Let's continue. Regulatory changes the impact, the cost, and amount that the regulated pays and can hold impacts demand for Treasury, but doesn't change reserves or duration held by private sector. That's pretty standard. Reserve amounts in a zero required reserves regime have very little impact on monetary conditions. It is zero required reserves regime have very little impact on monetary conditions. Duration held by the private sector has meaningful impact on financial conditions. This is how much of the long end is being held by the private sector. Repo programs slow down liquidations and backstop liquidity, but don't force demand for treasuries. It's not a push, not a pull. It's a push, not a pull force. Regulatory changes are also a push to the regulated entity and doesn't force them to buy. Okay. So these are just some definitions here, but this is going to help to set the stage for our next segment. This is going to be Daily Equity powered by Denari. Daily Equity today is going to be a little bit more like a macro corner because of this massive announcement from the Treasury yesterday. We're going to get into it. Let's go ahead. Daily Equity powered by Denari. All right, so yield curve control. Did Bessent just launch yield curve control? No, he did not. Okay, so let's get into it. You guys probably already know this from, or you might start to suspect this from the definitions that we just talked about, but no, Bessent did not just launch yield curve control. Let's talk about it. What did he actually launch? So this guy has a great newsletter. He talks about some of the macro environment things that are happening. And we're actually going to get into some of the sketches that he has, some of the charts that he has on this article. But we're going to move somewhat quickly through this, okay? And so I'm actually going to pull it up on my side, and we're going to walk through what we have going on in this article, okay? And so we're going to scroll along with you guys. And we're gonna mute the CFTC. Maybe we're gonna pull back that after our latest guest. But what's happening here in this article? Let's get into it, okay? And so this is obviously commenting on the Treasury announcement that we had as of yesterday, and he's saying that this is not the Treasury conducting yield curve control, okay? It rhymes with what he's talking about is that he wants to issue a clarification on how today's action impacts the thesis that he laid out for curve steepening being good for the cycle. Okay, and we'll get into curve steepening, bull flattening, bear steepening, bear flattening. All right, so what we have here is that what actually happened is that the Treasury has said that it is going to at least double the size of its liquidity support buybacks in the 10 to 20 year and the 20 to 30 year sectors. That is what we classify as the long end of the curve. Okay. And so he is at least going to double the buybacks from 2 billion to 4 billion at least per operation. I believe the operations happen weekly, and this is happening from the 9th of September all the way until the beginning of November. Okay. And it happened right after the 30-year printed its highest yield since 2007. So no coincidence that bonds dumped, yields spiked, and that is when he's issuing some liquidity support. I mean, this is literally at the highest levels of the most powerful economic system on the planet. This guy basically saying, steady lads, providing more capital. This is him deploying the liquidity supply here on the long end of the curve. And so he basically showed his hand. He said, look, this is my pain tolerance. I don't want the long end to go over a certain point. And now he has signaled that he's going to do everything in his power with repurchasing these long end bonds to bring it back under control and lower the yield that America has to pay on various parts of its debt, and also on what it has to pay for people to finance its government. The Treasury is simply using its flexibility to impact supply-demand dynamics across its own debt profile, buying back long paper and funding it with issuance further in on the curve, funding issuance on the shorter end and using it to buy the longer end. This is not QE, and this is not yield curve control. And so he's just kind of reshaping the yield curve, okay? Would you call it yield curve control if you bought back the fixed rate loan on your house in order to issue a floating rate loan instead? No, you wouldn't do that. That's just called refinancing your house. This is the same thing you're doing with the US Treasury. No new money is being created, so the money printer is not being turned on. In this transaction, the debt is rearranged, not monetized. And that's an important statement because it actually shows that money printer could still get turned on. Okay. The only way this turns into actual extra liquidity of the central bank created kind is if the Fed restarts its reserve management purchases of short-term bonds. And like we talked about, this would be if Bessent, in order to finance his purchases of the long end, because he's injecting supply into the long end, he's going to need to sell the short end. Okay. And what this does is it steepens the curve because you're going to dump the short end, you're going to increase the long end, and then your curve is going to look steeper. And if he's dumping the short end, he needs a buyer for the short end. And that's where the Fed could come in and print money and hold the short end on its balance sheet. Okay. And so this is where it gets interesting. Bessent is clearly hinting that the debt profile will be taken further inwards on the curve, meaning the short end of the curve. And the more he floods the front end with bills and short coupons, the more likely it becomes that the Fed eventually has to lean against it with exactly those purchases to keep money markets functioning. That is massive. That means that there could be a greater case for quantitative easing in the near future because Bessent has to sell short-end dated bonds in order to facilitate the liquidity supply that he is now showing in the long end of the curve. So sure, there's a potential liquidity angle in this, but note the keyword potential. It is a second round effect that requires the Fed to move, and it still has nothing to do with yield curve control. And then this article gets into the four curve regimes ranked. So we actually have our guest. We have our guest ready, and we want to get into the guest in a little bit. And I actually want to get his, so here's what we're going to get into, actually. Here's the pictures that we can talk about. These are the four cases. We might bring these pictures back with our guest, but let's actually stay on this for just a moment, okay? Because the article speaks to each of these scenarios. Okay. And so, we're going to talk about these four regimes. Okay. These four situations that we might see in really any situation. Here are the four possible curve actions as follows. We've got the bull steepener, the bear steepener, the bull flattener, and the bear flattener. So the bond market can either, the regime can either be bull or bear, and it can either go steeper or flatter. The ideal is that we get the bull steepener, okay? What happens in the bull steepener is that the short end gets dropped, the high end gets put under control, the curve steepens, and this is basically the dream for Trump and Bessent. If Warsh cooperates, this is going to make everything run wild, and this is what running the economy hot looks like. And so, a steeper curve, this is the bull steepener, a steeper curve, the business cycle runs hot. The action is led by the short end dropping in yield terms. You get the credit engine, steep curve equals more profitable maturity transformation, money creation, and you get rate relief for households and corporates at the same time. This is undoubtedly what Trump and Bessent are pushing for internally. Fed cuts in the front, left, and the long end left alone to breathe. The second best regime is the bear steepener, where the long end moves higher than the short end, okay? And this is what we could see as well. Less comfortable headlines, but the bank engine still runs. This is the regime we have effectively been in until yesterday, and then the market just sniffed out this bull steepener that Bessent is signaling. And this is also the regime that Japan has been in. We don't need to cover the other two so much because we've already seen that the Treasury is starting to signal that we are going to get into a steeper regime. We just don't know if it's going to be a bull steepener or a bear steepener. The last thing to talk about here, if we just scroll down a little bit more, is going to be why gold and Bitcoin outperformed, and it's because gold and Bitcoin are up, and we had a rotation out of tech because the liquidity wizardry described above is potentially forcing the front end flooding of bonds. The Fed is going to be forced on reserve management purchases, and you have the exact cocktail that scarce assets love: falling real rates if the Fed cuts, plus a whiff of future money printing if they end up taking the front end onto their balance sheet. This is exactly what Bitcoin and gold love to see. So again, we don't know if this is going to be the case, but now that Bessent is signaling that he's going to steepen the curve, that could force the Fed's hand. And this is a scenario that is very real for Bitcoin and gold and scarce assets in general. And that is why you finally see scarce assets like Bitcoin start to outperform the tech sector in the equities market. Massive reef shuffling. We're going to get the guest up. That is going to be the end of our daily equity segment for now. We're going to go solo shared for now with the guest. Why don't we go ahead and flip the title. We can go solo. Hope you guys enjoyed daily equity. It's a little bit of a macro insight. I mean, guys, I'm learning macro here in real time. It's pretty fun because it feels like everything is connected at a macro level. This is why we're seeing equities and digital assets and scarce assets all sort of rearrange around the bond market, because this was such a massive announcement from the Treasury yesterday. And so this is huge news. not just for digital assets, but for, the asset classes as a whole. And this is what we're seeing play out. So I think it's important to keep an eye on macro, because this is ultimately where a lot of these asset classes intersect and how they all converge. And so we're going to bring up our next guest, Quinn Markwith. He's going to join us. I think he's ready in the back, so we can go ahead and bring him up. He's an economist focused on the intersection of AI and digital assets. He's formerly an emerging markets economist at Capital Economics, and the #1 ranked Focus Economics forecaster for Peru, Colombia, and Chile in 2019. Entered crypto in 2017 with subsequent roles at eToro and DAO Maker. And so we're going to get his read on this Treasury announcement and just his general read on the reshuffling of the deck here between equities, AI rotation into digital assets, and the craziness over the last 48 hours. He's up on the show now. Quinn, welcome to the show, man. It's a pleasure to have you.
Hey, Robbie. Great. Thanks. Good to be here.
Absolutely, man. Well, it's been a whirlwind of the last couple of days. It's your first time on the show. Maybe you can just give us a little bit of an intro into yourself and why you stuck around in this space when everyone else went to AI and robotics, and what your read is on the last couple of days here.
Yeah, absolutely. So started out my career in research doing macroeconomics, tailoring the research more towards private banks for the most part, traders who are trading EM currencies, trading against central bank announcements like we've, developments like we've seen recently. Made my way over to eToro when I started out my work as, in sales, crypto markets related things. Kept up a little bit of analytical work as well over the year, focusing on macro and positioning within crypto as an asset market. Most recently on my BD side, I was building a market maker in crypto called Trireme, but lately I'm focusing on more an AI startup at the moment, but always trading this market, watching the market, and looking out for what's coming next.
Oh yeah, absolutely. So, we actually have a couple of diagrams that we're going to show in just a minute from a great article that talks about why this isn't yield curve control from the Treasury. Maybe you can talk to us about what this is and help us understand how this macro environment and how this bond regime is ultimately going to shift things, maybe make tech a little bit less attractive and make scarce assets like gold, Bitcoin, digital assets broadly a little bit more appealing.
Yeah, definitely. I mean, in my view, the bullish case for crypto assets in particular, like the ones you've described that are scarce, right? Readily available and liquid, has definitely gone up. It was already quite bullish, in my opinion, that in the last couple of months, a lot of the negative news that we would have expected to hit the market about 6 months, 9 months back would have been more pain, more bleeding. It was pretty resilient. And then with this news, which amounts basically to a signal that there is a clear story now over the next 2 years for the fiscal situation to be accommodative, as well as the monetary. So, with the way things are looking competitively within crypto and the way that the assets are holding up in light of news, overall the picture, or at least the thesis for a bullish next 2 years, is quite strong now on crypto assets.
It's incredible. We actually have a chart from an article that we were just referencing on the show. So we're going to go ahead and bring it up. And we'll show you in the chat here. If you click on our producer Leo, his screen in the chat, you'll see it zoom in. And so what we're coming to understand here is that with Bessent's announcement yesterday, he's doing this liquidity supply, this long dated bond buyback program. And basically, he's trying to buy the long end cheap and he's trying to sell the short end at a premium. And this is ultimately creating a steeper curve. Is that the right way to think about the liquidity announcement, the Treasury announcement yesterday? And then maybe you can help us understand, are we in this bull steepener regime, or are we in this bear steepener regime according to these 4 bond regimes here?
Yeah, I think, looking at, the 4 bond regimes all together and looking at also the context under which what we're seeing signaled from the Fed, the context from which that was born, right? We have a leader of the Fed right now who is viewing AI as sort of a structural factor towards being less bullish on inflation, while also, what they're handed, what they can't control is the energy structural pressure on inflation. So I think that what we're seeing is a clear shift away from the more bearish case that we were seeing with the forward guidance, at least in the way of actions voting, right? We were seeing forward guidance turn a little bit more bearish, but for now, it definitely looks like a strengthening for the camp that says the dollar could be weakening in a more calm way, which is typically quite bullish, right? I mean, it's a similar setup, I think, that we had 5 years back, except for at least the liquidity should be a little bit easier to tap into now in the system, which I think overall is quite good, because even during this last year, which has been quite bearish for crypto assets, you saw a lot of the development on the building side keep up pace, which kind of tracks with past cycles.
Yeah. The biggest unknown here feels like it's the short end. Like we don't know whether Warsh is going to comply and lower rates and cut rates, but that's pretty important to what it seems like Bessent's plan is, right?
Yeah, I think it would be counterproductive to make assumptions on the other way. I mean, until otherwise, it looks like the intention is to be more accommodative towards that kind of path of action rather than the hawkish.
Yeah, and so another portion of this is that if Bessent is injecting some or buying back some of the bonds on the long end, and he's selling on the short end, in order to do that, there needs to be a buyer on the short end. And actually, we've seen potentially stablecoin companies come in and say that they're interested in buying up some of these T-bills and these short dated bonds, but they might not have the firepower in order to really absorb a lot of the short end. We've also seen sovereigns sort of decrease their treasury bill holdings and their bond holdings. How likely do you think it is now that Warsh's hand is forced, and he is forced to come in and provide some quantitative easing? Do you have any idea of what his stance on quantitative easing has been in the past? And do you think it's more likely now that he does come in and absorbs some of the short dated bonds on the federal balance sheet?
I would say on balance, it's certainly more likely now after this latest shift. Like traditionally, to my understanding, he's quite hawkish, so that lends kind of a directional bent in my history of looking at many types of central bankers, and most of them, to be honest, given my background, weren't much like the Fed. They were dealing with much less deep markets. But given that the deficit is pretty unprecedented, and given what this latest behavior in the buying the longer dated bonds signals, I would say the case for shorter dated support has become stronger. And the other views of mine, which I think will just make me sound biased, I'll keep to myself. But I see a picture here where I am kind of a buyer of the idea that money can swing from AI stocks back to crypto, and I have my reasons. But it does look like a lot of the more bullish parts of crypto, as I see them, are starting to heat up a little bit, which is encouraging, I think, to that gut feeling that I have.
It was, incredible timing.
Yeah.
Could it have been? I don't know if it could have been a coincidence that President Trump is up there, shaking his hands, talking about hyperliquid coming to the U.S. the same day that Bessent makes this liquidity, supply announcement. Like, what are the odds? That must have been coordinated.
Yeah, I think it's tempting. I think if you're doing your job right as an analyst on this market, like you should be coming to conclusions like that and asking yourself if you're going crazy. But that's what it felt like to me, certainly. Yeah.
I gotta know, man. Tell us about these biases. It's helpful context.
Sure. I'm just I'm a bull on what AI can do when given a blockchain wallet. I definitely found that my interest in the sector, in the space, over the last 2 years accelerated in a way I didn't think it would, because I did not see that coming. The AI agentic, use case until 2.5 years ago. I was already bullish from like a structural sense in the way that a lot of people are, if they're thinking about just in terms of flaws with the traditional financial system. But the AI route definitely helped renew my interest. So yeah, I look at the developments on Base. I think about a lot of the buyers that can come in from the Robinhood chain, and I look at how active the communities are, even in what is a very bearish last 12 months. Yeah, pretty encouraged on that bull case in particular, being AI operating on chain.
Yeah, very cool. And we just spoke with someone, Shafu, who just got hired by Circle to lead AI agent payments over there.
Yeah.
Gives a whole rundown on X402. 16.5 million transactions gone through X402 up until this point. Almost 10 million of them on Base. So yeah, you're absolutely right. I mean, Coinbase, being like a core inventor of X402,
right.
The predominant majority of X402 transactions happening on Base, and now significant investment from Circle to, go deeper into this agentic payments route. I think you're absolutely right. I think this is, a potential vector for a massive explosion in activity when it comes to agentic payments. This is, one facet of what we're seeing and the growth that we're seeing. And then on the other hand, you've got things like perps, literally being integrated into the highest levels of finance, and just the overhaul of the financial system happening right before our eyes. It feels like, and then you add in tokenized equities that come in, and, the TVL into these DeFi protocols re-rates so much higher with a much higher TAM. It feels like the confluence is just really starting, to hit on all cylinders. So it's very cool to see, especially once you add in a macro regime that is particularly accommodative.
Right.
It feels like, now we're really hitting a stride here. I want to just get into another diagram based on these four regimes.
Sure.
How we could see the reactions in the market. So let's go ahead, flip to the next one. And you'll see how each market reacts to each of these regimes. I'm just curious to get your take on this, because obviously there has been, increase in M2, and typically what we saw was that Bitcoin tracked M2, Bitcoin obviously being, kind of the indicator for the rest of the altcoin complex. But a lot of that money didn't flow into Bitcoin. We had this decoupling, and a lot of that M2 ended up flowing into the AI build out. And I think part of why, if we hold this diagram to be true, is that we were in this bear steepener regime where the long end was up, and then tech and the real economy tended to outperform, and a lot of that ended up coming from the AI build out. But what we're transitioning from, and this is where I'm curious to get your take, is that we're transitioning from a bear steepener into a bull steepener. And again, we need the Fed to comply here. But if this is the case, the scarce assets are going to outperform, rates are going to compress, we get a credit and a rate relief rally, and we allow the economy to run hot. It is somewhat dependent on letting inflation run hot, but this is ultimately what would allow all of these asset classes to flourish, and we would get this bull steepener regime, in which case tech, AI build out, and scarce assets all do incredibly well.
Yeah. No, I like that breakdown of it. It makes it, and how you illustrated there. Yeah, I'm definitely in more of the bull steepener camp now, at least given what I've seen, right? Because, this regime's a bit different in the way of forward guidance, as I said earlier, but yeah, typically, actions when the market is, when a central bank knows that the market is already uneasy about something like inflation expectations due to something structural like that, and the clear behaviors are in line with loosening, I would say the bull steepener here makes the most sense. And I wouldn't be surprised if in the short term, equities continue to outperform crypto a little bit. But ultimately, I could see within the next 2 years, I don't think it's unrealistic to say that within about 2 years, you get that extra bit of what makes the bull steepener what it is, which is that, tailwinds from, it being actual scarce assets that are the ones being pursued by institutions as a result of these consequences.
Okay. And so the scarcity really starts to come into play because, and is it because people are looking for an inflation hedge because the economy has run so hot that now they're pivoting towards something with a fixed supply?
Yeah, well, how I sometimes see it playing out, and this is just, fun imagination. It's not like any kind of thesis that I would bet money on right now because a lot is in flux, and I think it could take easily 2 to 5 years to play out. But ultimately, yeah, these kinds of up moves in a market where the underlying asset, like the dollar, I think, in my opinion, it depends on how many more weakening cycles you think it can go through. I'm kind of in the camp that there's only so many more times it can weaken in this way that's hyper bullish for assets as we've seen them in the West. So I'm kind of in the camp that, somewhere in the camp of about 18 months to 24 months, we should see a dramatic enough move on the bull steepener case that, the market starts to price in what happens next. So yeah, overall, yeah, you could say I'm a bull steepener.
And so what happens next? I mean, it sounds like, it sounds like just maybe we just start with this liquidity supply in the long end, right? It's going to steepen the long end. We know this is going to run from September 9th, I think, until early November. Bessent has already gone on CNBC this morning and said we could do even more. And then at some point, it feels like the Fed, might get their hand forced to come in and buy some of the short end. That is sort of the next couple of months. But when you look 18 to 24 months out and you say the market starts to price in what happens next,
just meant for, overall, depending on your picture of, where the U.S., I guess, sits in its fiscal cycle, there's a lot of arguments to be had that, that delicate undergirding, when you are pushing as hard as we're about to see, I think it swing in the way of the fiscal and monetary stimulus, it's, you typically get some kind of snapback. So yeah, just speaking off the cuff right now, not making any particular forecasts. It's just, I guess you could say that I'm in the camp that rather than needing to wait for 10 years for that scarce asset type thesis for digital assets to also play out, I'm saying it could happen a lot quicker, I think, in my opinion, just because of in particular, the fiscal situation does seem to actually be ramping up now to a more serious degree.
And when you say the fiscal situation, this would mean, like in the extreme case, we're talking like Ray Dalio's,
that would be like
debt
the extreme case,
debt spiral, end of the West, hyperinflation, print our way out of it.
Yeah, not making any dramatic claims on like direction or timing as of yet, but yeah, like in my experience, if you look at what tools are in the toolbox, it would lend itself at least over time. In the short term, maybe 5-10 years. In the short, if you want to put a shorter window of time on it, it would be maximally bullish if your prediction was at least some kind of monetary regime change, and it just so happens that one of the asset classes that's most sensitive to signaling of like, let's say, short-term dollar weakness even, just so happens to also present some nice trade-offs from the system itself, which is driving that demand. So you got kind of a double whammy on both sides, I think, that makes a nice little feedback loop.
Wow. Incredible. Okay. And I mean, is there anything that you're watching, in the near term that would just, any indicators, anything that you're listening from the Treasury or from the Fed that would tell you, okay, further confirmation of this thesis, or what could happen that would invalidate part of the thesis that you're describing?
Yeah, I think in the short term, for one, the pace at which the AI agents demand comes online is a big factor that no one really knows, and it feels like this elephant in the room, right? And it feels also like something that could change more quickly than we think, but it's a hard one, right? Because it could take anywhere from months to years to see that kind of demand really bear out. It's also, it doesn't seem like there's a strong case that can be made just from, publicly available info that, some of the loosening that I'm talking about doesn't take more like 6 months or 12 months. I'm kind of leaning towards it perhaps happening quicker, but on balance, it's hard to make a case either way. So, yeah, I would say bullish, but with reasons to be definitely reserved about the timing on that for sure.
Okay, and it sounds like every time we start to get into this, really aggressive steepening regime, we start to run the run the economy hot, we get into a risk of that spiral.
Right.
And so now the market is sniffing that out. That's why the scarce asset thesis is starting to revive.
Mm.
And so we could get so far down the line that ultimately it flips over the edge and this thing spills over. And that is what the market is sniffing out. But we don't really have confirmation of that until we ultimately go through with it.
Yeah, exactly. Like, I would agree with that framing of it, because part of the, what the market's expecting is right for the old remedies to continue to work in the way that they have in the past, and they may for a time, right? But I think that we'll probably see compressed like time frames to understand like the full consequences of whatever fiscal or monetary does next. So we didn't have to wait too long after we see the action, I think.
And are you primarily, sort of allocating towards these scarce assets with, what we call monetary premium? People look at them as inflation hedge, store of value, gold, Bitcoin. We're big Zcash bulls on the show as well. There's also kind of this on-chain business, like revenue meta that's happening.
Yeah.
And there's a lot of really, really solid projects that are starting to do buybacks and accrue more value to their token. Do you think any one of those has, and we've kind of separated these into two classes or groups of tokens. Do you think there's any merit to the on-chain revenue generating value accrual fundamental, or are you primarily focused on, the Bitcoin, gold, Zcash side of the equation?
Yeah, I would say I used to be more in the former camp of like the more institutional sized, highly liquid ones like Bitcoin and Zcash and these kind of things. But in recent years, like I've definitely had my ear a bit closer to the on-chain world, just because I'm really fascinated by how the competing organizations compete for liquidity, compete for attention, try to incentivize people to get involved with their products. And I kind of view it from that angle when I'm thinking about allocation and how I advise clients to allocate. It would be, you keep the macro picture in mind to understand kind of the barometer forces behind the market, but I'm always trying to keep a very nimble mind when it comes to actual allocation. It's about, for me, what's going to be capturing attention next, and there's all sorts of factors that go into how you determine that, but a little bit of an ear to the ground on each of those kind of assets, whether it's real world assets, AI, doesn't matter so much to me. It's more about being where the sun's going to shine next.
Yeah, very cool. Well, Quinn, you spent plenty of time with us. Really appreciate it, and thank you so much for joining. The last thing I got for you, and I don't want to put you on the spot, but given this regime that we're faced with and where the light is going to shine, just curious to get your Bitcoin prediction. Maybe end of 20. Let's go like 12 months from now. We're like mid 2027. Curve is steeper. We're going into Q3, Q4 27, looking at pretty positive in some ways. 2028. What kind of prediction do you have over the next couple of years for Bitcoin?
Yeah, right now I'm kind of in the camp of, it looks, I have to give credit to my former employer. They held steadfast to the 4-year cycle call. They called a October 24 peak, and it did kind of roughly play out that way. And just given that we just had kind of a down year, and just given everything we've said about the macro setup, I wouldn't be surprised if by mid next year that it's probably above 6 figures. I guess that could be a price call. But if not, it would be probably due to things which right now, if I had to bet, would be more short-term headwinds. But let's see if how what will be really interesting is to see how Bitcoin in this new kind of monetary environment that I think the market just priced in. I wouldn't say new environment just yet, but to see how it continues to react to news or doesn't react to news in the next couple months would be really telling.
Yeah. Yeah, if the last couple of days is any indication, we are about to see. I think the six figures prediction is a pretty safe bet. So we'll see how this plays out in this new regime. But yeah, you're absolutely right, and that we are starting to see these things shift. And I think you're ahead of the curve. Quinn, thank you so much, man. Really appreciate you coming on. Would love to have you back. We don't talk about macro too often on this show, but I think you're a great guy to chat macro with. So appreciate it.
Let's do it. All right. Sounds good, Robbie. Thanks again. Thanks, everybody.
Absolutely. We'll see you next time. Thanks, Quinn.
Take care. Bye.
Bye. All right, guys. Yeah, I mean, that's a phenomenal segment right there. On the macro front, you guys heard about the liquidity situation, the liquidity supply on the long end, what the Fed could do. I personally have really appreciated the education that I've gotten in the bond market over the last couple days. So let's go ahead and bring up the CFTC show one more time. Let's get some volume and some closed captions on it as well.
Not
we'll listen
the
in a
number
little
one
bit
spot
more.
right now. Right now, the market for compute is just beginning to develop, but most of it's already developing offshore. Why? Two reasons in my view. The first is it's really hard to assign a spot value to compute, right? Which means it's hard to come up with an index price, which means it's hard to offer a futures. The second reason is that, entrepreneurs have watched the lawfare of the last few years. And while it's true that there's nothing preventing you from launching something for compute, there's no safe harbor to launch it under. And I think it's incredibly important for regulators such as the CFTC to have some kind of zone, as Tushar was saying, that allows people to experiment, to try things that frankly may or may not work, to figure out how to do this and how to keep America first. And without some sort of assurances, it's very hard as an entrepreneur to put yourself in the kind of jeopardy that you would be putting yourself in based on the last few years of the prior administration. The last thing I would just say is, I think with something moving as fast as AI, I agree with my colleague Mike, less is more. We have to figure out how to keep people responsible, how to make sure that, we're doing our absolute best for the consumer, but we're gonna have to move incredibly fast as a country to make sure that we stay at the sort of peak competitiveness globally for AI innovation adoption. Thank you.
Thanks, Peter. Joe.
Thank you. So I agree, as others do, with Brian that there will be a positive asymmetry for the builders over the breakers of code, provided both have good access to machine intelligence. But there is a timeline to it. I read a stat a while ago that for every 1,000 lines of code, there's something like 15 bugs in the code. And so the world is saturated with terrible software. Most of the time, it doesn't matter. In our industry, it matters quite a bit. And so we do a lot of work, security auditing, and different kinds of verification. So I would encourage the CFTC and the world to really lean into the idea of open source, open protocols, to the extent that we can move away from obfuscation as a tool for security. That'll be much better for us because your software has probably been downloaded by somebody, and machine intelligence can now reverse compile it and run machine intelligence on essentially something that you think nobody has access to. And so your developers may not be quite as alert as they should be in that sort of situation. There's a timeline to the asymmetrical dominance that builders will have. So we're going to probably see a lot of exploits over the next little while because there are a lot of projects in the crypto industry and in other places that are over from the perspective of the builders, where people aren't behind the wheel, aren't aren't paying attention to what they built. Again, there's a lot of software that doesn't run on live monetary rails, and that's less concerning. But we're going to see a bunch more exploits over the next year or so because there's just a lot of defunct live monetary rail projects out there. So we shouldn't overreact to those sorts of things. In the Ethereum ecosystem, we at the protocol level, at the smart contract or application layer, we have transparency, we have credible neutrality, we have verifiable transactions, and for well-formed transactions and well-formed programs, we have guaranteed execution. What we're moving into now is the ability, as both Vlads, I think, mentioned, the ability to formally verify, so mathematically verify the correctness of the code. So we'll be able to mathematically verify the correctness of the Ethereum protocol, and we do a lot of that work already. We're going to be able to formally verify the correctness of DeFi protocols. That's, I think we're going to move into a golden era for software. It's going to take a lot of work to get there. I would encourage you with your convening power and hopeful openness to harmonization to think about the holistic nature of the open source, open protocols ecosystem. I mentioned before that there are cracks between protocols, and that's where it's hard to reason logically to identify where vulnerabilities are. Giant machine intelligences are able to, with their breadth, with a huge amount of activity, they're able to look at a lot of the cracks between protocols and how you could line up 6 different subtle things into an exploit. And so there should be ways of not just formally verifying each individual element, but taking a holistic approach. And that's where accountability may lie. If we can proactively prove that all these different systems, if taken as a closed system, are formally verifiable and therefore correct, then we may not have to do the forensic type of work that we've had to in traditional finance.
Thank you. Thank you, Joe. I have Scott, Carla, and then Anatoly, I think, and then we'll round out today. But if we only have about 5 minutes left, if you can keep your comments concise, that'd be appreciated.
Thanks, Walt. As was mentioned by both Don and Tom, this does have very similar look and feel as the high-frequency trading algorithm discussion we had. Don, it was only 16 years, it wasn't 20 years, so we're not that old. But it was what was very kind of scary technology first approach. How do we make sure that we don't let this run away with our markets? What we found, and just Walt, even though you did mention principles-based, it did not stop the commission from coming up with a proposal to send all code to the commission. And that's not the right response to this. What we found and what was enduring was we relied on all the infrastructures, the FCMs, the clearing houses, the trading platforms. There were several people in this room that are on this panel today that were in that discussion then. We talked about how you maintain oversight responsibility. What we found were the clearing houses and the trading platforms were the best integrators and basically frontline protection to making sure that our markets, they ran test data, they looked at different things to make sure anything that did go into the market had been pre-vetted. I appreciate AI is a bigger beast than trading algorithms that we were dealing with 15, 16 years ago. So, and the point about DeFi is going to have to be addressed as well. I think it is this commission working with the industry and on-chain providers, et cetera, as to how they're going to help us make sure that our markets are safe is critically important, but it's going to take everybody's involvement, and I appreciate the leadership here.
And thanks for your work back in the 2010s on this issue. So, Carla.
Yeah, so 2 points. First, on the issue of AI, as someone down the line here mentioned, that we could adapt the third-party or outsourcing supply chain rules that exist to AI questions. The one thing I'd say is I'd encourage the Commission to think about how far up the software chain those obligations should be passed. It would do two things. One, it would provide clarity in that regard for AI developers, but two, the clarity itself may, as a colleague Kish Pearl and I have argued in a recent paper forthcoming in Texas A&M Law Review, it may trigger corporate governance and other private law enforcement powers that would help ensure security in AI models. Simply by clarifying at the regulatory level, you can trigger other obligations under private law. And then secondly, as to the DeFi accountability question, I just want to reiterate again the importance of focusing on function. Not all DeFi, things that are labeled DeFi function the same way or achieve the same end. And there are indeed certain DeFi protocols that operate as infrastructural resources. Generally speaking, capital markets regulation targets intermediaries as the object of regulation, and pretending that infrastructural resources that are DeFi protocols are somehow an intermediary that must be held accountable to law that doesn't apply to them is actually detrimental to the legal enterprise, as I argued in a paper called Law's Detrimental Reliance on Intermediaries out of George Washington Law Review. So simply reminding the room that not all DeFi is subject to the law that we want to hold it accountable to, and pretending that it is not helpful.
Very helpful. Thank you, Carla. Anatoly?
Just to add a bit about decentralization, I think once you guys approve like a product, whether it's perps or whatever, and you approve a certain implementation of it, if it happens to look like a centralized server where people can trade, looks and feels like Coinbase, it's very hard to come and say, here's a smart contract that is functionally equivalent that provides the same service. Can you approve this? Because once you guys have done the work to kind of do the due diligence on a certain way to do things, that becomes a standard. And that becomes very hard for systems that take longer because they're decentralized, because we're trying to do things, formally verified in an open source way to compete there. And those will get built offshore, because it's just code, right? So if those systems are better because there's all these properties that they can guarantee for users, but we can't get them approved, even though it's functionally the same, you effectively created a regulatory structure that only approves a certain implementation. And that becomes very frustrating.
Thank you, Anatoly. Well, this wraps up our discussion on AI for the day, and we want to turn to our final issue, which is prediction markets and the evolution of the regulatory structure there. I actually was at the commission in the 2000s when we approved the first prediction market. We also released the first request for information around event markets in 2008. So this issue has been percolating for a while. It's recently exploded, and now who knew it was going to be on the bingo card 2 years ago, but it is. And it's on the bingo card because it's demonstrated its immense power to bring information centrally and price discover a variety of different types of commodities and products and things. But it has come with legal and policy questions that we want to dive in today. Certain recent litigation and differing views among federal and state authorities make this an ideal time to talk about how the regulatory structure should look for prediction markets. And indeed, the CFTC has been quite active in this area. They've already released 2 rulemakings on proposals and a handful of other staff advisories as well. But given there are several prediction operators in the audience here today, and those that have invested in prediction markets, I'd like to ask, what lessons should regulators learn from the state and federal developments that have been happening over the next few months in order to evolve these types of markets? We'll open it up. Is that Luke? I'm trying to, Luke, you have your, go ahead.
Yes, thank you. My name is Luke. I'm the CEO of Binomial.
We were recently acquired by Payward, and so a lot of what we do is traditional crypto business. We recently launched 2C2D retail spot margin trading. We're known for things like the first globally equivalent US perpetual futures. We also have crypto as margin collateral. But weirdly, why we're talking in this prediction market space is because we also offer a lot of infrastructure services to other companies, some of which are in this room. And so even though prediction markets are in many times vertically integrated and direct retail clearing, we offer a lot of different services with a lot of different structures for clearing those prediction markets on the exchange, on the clearinghouse. And so I guess just to keep it quick, what we would ask from the commission is please just keep an open mind when drafting new regulation and thinking about how to put all this together. I think there's a lot more differences in the ecosystem and in the space than maybe even we realized when we were first getting into it. I think in the futures world, we're very used to kind of the CMU way of doing things. It's very well established. But it's the diversity is quite a bit more pervasive than we would originally see on the surface. So thank you for having me here.
Thank you, Luke. Luana?
Hi, I'm Luana. I'm one of the co-founders of Kaushi. First of all, thank you so much. Thank you so much, Chair, and all of you for having us here. I also really want to thank the CFTC staff because we're here talking about all this innovation, but it just means an insane amount of work for them to be able to, in a very prompt manner, answer all of our questions and help us work through all of these issues, and we're really grateful. In a lot of ways, Kaushi had a very different path than the traditional, the crypto companies that talked here. We started the company in 2018, and from the start, we wanted to get regulated because, as you said, these are not, prediction markets are not necessarily new. They've been around for a very long time. And we knew that the right way to do it was coming through the front door and working with the CFTC on how to bring them here. But we had the issue was actually that even though we became regulated, it was years of the CFTC not allowing us to launch any products or do anything. And meanwhile, offshore competitors were really, really growing and taking a lot of market share. And it took, instead of the courts suing us or an agency suing us, we had to sue the CFTC to make sure that the law was being applied in the correct way. And I think a lot of the prediction market growth that we've seen after that came because of this lawsuit, really just reinforcing prediction markets and the regulatory framework here in the US. And what we learned after is that actually Americans really like regulated platforms. If you see the market share of onshore US-based prediction markets now versus in the past, the majority of the market is now in the US because Americans like regulation, they like consumer protections, they like having something here that they know the face, they know where it's coming from, and they know that the government is there to help and look it over. And yeah, a lot of the issues on the state regulation, as you said, state versus federal, have been around for over 100 years, multiple Supreme Court cases, and all of them ended up enforcing the CFTC's exclusive jurisdiction on regulating these markets. And a lot of these lawsuits are actually becoming very dangerous because of how broad they are. If you look at New York, for example, they're not just about sports, they're not just about prediction markets. A lot of companies here that actually never touch prediction markets could be interpreted to being under a lot of what New York State is trying to make happen. And I think it comes from a fundamental misunderstanding of the benefits of these markets. So when we started Kaushi actually in 2018, the idea for Kaushi came from our time working in Wall Street and seeing how investors actually didn't have a good option, a good alternative, a good way to hedge Brexit or elections or a lot of things that just wasn't a direct, transparent market where you could buy and sell future events. And being able to hedge this risk that was unhedgeable was one of the main reasons we started Kaushi. And on the other side, on the price basing side, it's extremely, this is the kind of like the bread and butter of why prediction markets are important. Over 75% of our users, they never traded on the platform. They just come to consume information. And actually, just earlier today, we released the largest study to date on calibration on prediction markets, showing how good these markets are at forecasting the future. So when we talk about defending these markets in the US, it's less, there's obviously very important on the activity and the hedging side, but it's multiples larger on the people that use these markets for information and to have a way to have unbiased view of what's going to happen in the future, especially in a world so polarized by the news. And with that, I think the only other two things I wanted to add is on consumer protection. I think that there's a lot of the attacks is on the consumer protection side, and I've never heard a single argument on why state by state has better consumer protection than a federal framework. If you look at actually, if you go state by state, you see that very few states actually have any regulation against advertising to minors or any regulation against advertising to self-excluded or people have retail that has shown some issues. And I think this is an opportunity for the CFTC to yet again show we can be great at consumer protection. And my last point on the SEC and CFTC harmonization. Well, our take on this is that it's very important that we keep markets efficient and that we allow competition competition and users to really pick what is better for them. And I think that it's important that we let different companies compete and different models compete so that the users, at the end of the day, can compete and can decide which type of market or which type of structure is important and better for them. And at the end of the day, efficiency is very important. And I would urge you guys to just look at how do we bring innovation in a fast way and allow a lot of participants to participate. Thank you so much.
Thank you, Luana. One concept I want to throw out here, and I see Craig and Terry in the audience, but in the 90s when we were struggling with whether derivatives, over-the-counter derivatives, were futures or not, we brought clarity to that in 2000. And I think the concern was that these were competing products, that there was a zero-sum game. They would one for the other. But we found out, and the futures markets took off after we brought legal certainty to the over-the-counter markets. And so my question to the group is whether event contracts and prediction markets are complementary products to a lot of the derivatives we see. Are they going to enhance risk management in ways we can't do it today? To me, that seems analogous, but I would love people's opinions on that, or whether they're substitute products. I got Craig and then Terry next.
Thank you, Walt, and thank you, Chairman Seelig, for convening this group. It's an impressive group of people, and the intellectual firepower in the room is quite evident, and I think bodes well for the future of our industry and the continued growth that we have. Being probably one of the more tenured people in the room, it's a great privilege to be with a lot of the young, bright people who are bringing innovation and new ideas to our market, which I think are great. I think the work of the Commission in terms of improving legal certainty in crypto, advancing tokenization, and on-chain transactions will all be very good if done the right way for our industry. I think earlier, maybe late last year, I had the chance to meet Shane, and I was very excited to meet him because I so respect his story and what he's done. And like he did with you today, Chair, he greeted me by saying, "What up?" And then he said, "Oh, you're the OG." And when he left, I had to ask my younger colleagues what was meant by that. And I was educated about what it means to be an original gangster, I guess. But which makes me feel really old. I think a lot of the topics today, while they seem new, and there are certainly new elements to them, the intersection of innovation, competition, and jurisdictional disputes and border skirmishes about products is not at all new. I think I've been in this room for almost 4 decades listening to conversations like this that are very similar. I also want to thank the chair for the recitation of the history of the development of these markets, which I think is really apropos for talking about and trying to solve a lot of the issues that I know you're looking for input on today. I had to laugh when you were talking about the floral shop underneath the Board of Trade, and many of you may not know, but I had the great privilege of knowing Terry Duffy's mother, who was an extraordinary and wonderful woman, and she owned a floral shop in Chicago, and I didn't want to interrupt you, but I wanted to just say, Terry and I were there in 1848 when that was happening. But on a more serious note, I think one of the things that I would say is Yes, it's true. Internationally, there are different regulatory paradigms that are used to promote both securities and futures and swaps markets. I would encourage all of us to actually turn this on its head and look at the great success that we've had by having a bifurcated regulatory regime in our country. Yes, we do have border skirmishes and they happen over products, from time to time. And as an industry, we've had to fight about those things and we've had to sort them out. But we've generally done it in a really successful way. Today, the equity market capitalization of US companies is by far greater than the market capitalization of every other country in the world combined. That's pretty successful. If you look at exchange traded derivatives and over-the-counter markets, similarly, the US represents a dominant market share in what we have done. And that's because we have regulatory regimes that are tailored for entirely different markets. Customers, users, futures and options and swaps markets have typically been geared toward the professional, wholesale, institutional, highly sophisticated, large institutional market. Securities markets have obviously been geared toward protecting individual investors and retail customers. And so the ability to tailor those regimes, which are very, very different and operate very, very differently, have fostered growth and they've fostered innovation and they've fostered competition. And we wouldn't be where we are in terms of market share and the dominant place that we have in the global marketplace if we didn't have that. So I just leave you with the following, which is that, there are areas that are black and white and there are areas that are gray. And I've been doing this a long time and a lot of the gray areas are very complex and they're difficult. And I'll just express appreciation for the difficult tasks that the commission staff at both the SEC and the CFTC have in sorting out those gray areas. But we have also the different regimes. And so, on the CFTC side, even though I'm generally a big fan of self-certification and the ability to do things quickly, especially in the context of a professional wholesale financial market with sophisticated customers, we also have securities products that are trading on CFTC markets. We have yes-no binary options contracts that were approved for trading as securities on the Chicago Board Options Exchange 15 years ago. And so we see a proliferation of those things happening on CFTC DCMs pursuant to self-certification today, but economically and legally, they are securities, and there's no question about it. The 1934 Act defines a security broadly to include any put, call, straddle, option, or privilege on a security, certificate of deposit, or group of index securities based on the value thereof. It's clearly a security, both economically and legally. The definition of a swap added to the Commodity Exchange Act excludes all those things I just said. So I would encourage the regulators, stay away from the black and white, figure out the shades of gray. There are shades of gray. We don't have time to talk about what they are today. But the consequences of not doing that, and I'd like to go back to where former Chair Walt Lucan started, which is our job, I think, as an industry, is to promote responsible innovation and fair competition. And it's to effectuate safety and soundness and customer protection. We can't do that when we blur the lines on what is black and white. And there's a limit. There's a limit to what the regulators can do. They're bound by the law. They're bound by what Congress has done. And more importantly, in securities markets, they're boundaried by the fact that there isn't exhaustive federal preemption of securities laws. They are regulated to some degree by the states. And so when you have securities products that are unregistered trading on a DCM, no matter what the regulators want to do, at some point there's going to be litigation. At some point there'll be rescission exercised by customers on those platforms at the state level or at the federal level, because they can do it both ways. And those are risks that don't promote safety and soundness. They don't protect customers. And they do the opposite of what I think the spirit of this whole meeting today is to do, which is foster legal certainty and protect customers, give them a safe environment to execute. So thank you very much. I appreciate the opportunity to provide those comments.
Thank you, Craig. Terry.
Well, thank you all. Appreciate it very much. Chair Seelig, Mike, thank you very much for holding this event. Appreciate it. I want to thank you, Craig, for referencing my mother. I miss her dearly. She was the reason that I'm in this room today. She was a big supporter of mine 45 years ago when I got into this business. So, and she was a great florist too. Craig is right. I want to talk a little bit about a couple of things. First, I want to thank all my colleagues sitting around a table that talked so eloquently about the crypto industry in of itself. I'm a big supporter of the crypto markets. I have been since 2017. We're the largest futures exchange in the United States, largest futures exchange in the world by volume. We are a big crypto franchise. I listed crypto back in 2017 when others would not do so. And we did it because we thought the timing was right and we wanted to promote and support the product. I know that SIBO was down the path of listing it back then too, but then they got away from it. That was before I think you joined the firm, Craig. But we're a big supporter of it. So listening to the group around the table today, I'm very heartened where the crypto industry is at, where I think it can continue to grow, and I think it'll be a part of our lives for many years to come. So that being said, thank you very much for all that and educating me even further today. On the AI stuff, I mean, I believe from an exchange standpoint, from a market structure for all of us in that world, you know, we have to look to how to embrace it and what the guardrails are to make sure it's running properly. But really, when I look at artificial intelligence, I look at the algorithms that some of the firms are running today for their risk management protocols and how they are going to mitigate and manage risk for their, either as a fiduciary or on behalf of their own firm. So I think that is fabulous that AI is going into these programs as long as it's done responsibly. So thank you for that conversation. I want to talk a little bit about the prediction markets, and I'm a little concerned about this, and I'm a lot concerned about it. There's been 2,500 self-certifications since this administration has taken office in January of 2025, of which none have been opposed. And there's been a lot of self-certifications around products that are in violation of core principle 3s, which is susceptible to manipulation. There's no doubt about it. And if you don't think that's true, then you don't watch the news. Because if you looked at the Maduro situation, if you looked at the teleprompter situation from the President of the United States, there's a lot of things that are susceptible to manipulation. There's some sporting events that are not just outcome-based or individual-based, that are definitely people that are manipulating these contracts. That is not good for our industry. That's horrible for our industry. We're not a bunch of carnival barkers at a circus. We are running the most envious markets in the world in the United States of America. Chair Seelig, President Trump, has said how they want to make America the crypto capital of the world. Well, we don't want to chase our own participants out of our own markets either. And by listing susceptible markets to manipulation, it is really doing the opposite of what we're trying to effectuate. So I would hope that the commission—
record there. Those products are not listed in the United States. They never were. This occurred offshore, and that's fake news.
Fake news? Okay, that's a cute comment too. So you're suggesting that some of these sports events are not listed in the United States?
The Maduro contract and the teleprompter-related contract were not listed in the United States.
I understand they're on Polymarket's contract. They were listed overseas. Fair? Yes, that's the answer. So regardless of the circumstances, that the president's own teleprompter operator was in the manipulation. That was not good, and I believe you are looking at the investigation to that. That's neither here nor there. I'm just bringing it up. That's not good for markets. We can get into a back and forth if you like. I'm happy to do that too. There's another really economic contract that has been massively important for the United States. That's a Nathan's hot dog eating contest. That's another prediction market that is on a US platform. It was called Kalshi. Kalshi also has a compute contract where when Don Wilson says, why are we having a 60-day period on compute? Kalshi was already approved for a prediction market on compute. Doesn't make any sense. Now, Cantor Fitzgerald is now partnering with Kalshi on that compute. Okay, we'll just call that a coincidence. Perps. I listened to all the conversation, but perps, 24/7 oil, which is something we want to do here in the United States. Why? Because these are having an impact on our markets off the decentralized finance platforms on Trade XYZ on Hyperliquid's platform. Now, these are illegal to US participants. I would have to ask the commission what they are doing to police everybody's VPN where they are not accessing these markets. They are having an impact on this, but yet we are being held up, others are being held up, Kelsey's being held up on trying to list 24/7 markets. Some people like them, some people hate them. I think all markets are going 24/7. I do believe that. That's just a matter of time. The banking system's got to get there, the federal government's got to get there, and we will get there. But I think it's truly important that we don't have double standards for people that have prediction markets on compute, but yet we will not have a listed spec contracts that we have out for compute going through these long review processes for reasons I don't know when there's already one approved by a US entity by the CFTC. So I appreciate you having this meeting, but I think it's important for us to go forward as innovators on markets to have a level playing field and make sure that the consumer is always protected. Because the best way to ruin a market, and I guess I'm old enough to recall in 2008 and 9, when the financial industry takes bad behavior, it doesn't take a step backwards. It takes 20. It takes years to respond, to build back the financial system. We've been able to do that, and I hope we don't go backwards again. I appreciate the time today.
Yeah. Thank you. Henry.
Yeah, Harry Crane.
Oh, Harry, I'm sorry.
Professor at Rutgers University and director of the graduate program in FinTech Analytics, which for which all of the topics here are certainly relevant. And I appreciate the opportunity to speak here and to discuss these topics, especially on prediction markets, which I've been involved in to some degree or another for almost 20 years now, of course, going back long before the CFTC has been treating them over the since Commissioner Seelig. There's a few topics specifically that I want to address on the topic of, first of all, principles-based regulation, I think, is crucial for driving innovation. And I'm glad to see that the rulemaking that's been proposed by Commissioner Seelig and the CFTC is vastly different than the rules that were proposed for prediction markets several years ago. In particular, on the topic of the enumerated topics, war, terrorism, assassination, gaming, other topics that are illegal under federal or state law. It's very important to get clarity on what these terms actually mean, because that's the only way for these markets to operate properly. But one thing that I would urge the Commission is that these are also the topics that are among the most important and potentially the most useful and valuable to offer markets on from both a financial and an information standpoint. You can think of markets on war. Of course, there are huge risk exposures to these types of markets, and it's also extremely valuable information to the general public. We also have, everybody here would also, of course, agree that these are very sensitive topics, and so they have to be addressed appropriately. But I think that in the spirit of innovation, it's important to not stifle potential innovation in those markets. I think actually the sensitivities only emphasize the need for innovation rather than prohibition. As far as the state issue, well, first of all, on the topic of sports, which is related to states, it's very clear that sports have a huge economic impact. It's a $100 billion at least annual industry plus travel, hospitality industry downstream. The states are approaching sports, however, as a gambling product. We haven't seen the true value of sports markets when it's treated as a financial product. There are very few examples out there. There was one several years back in the Mattress Mac hedging case, where there was actually a very innovative marketing marketing approach by a furniture store related to the Houston Astros winning the World Series. Well, this actually led to a $50 million liability for a furniture company, which was subsequently hedged at that time in the state-regulated sports books. So there are these use cases, and the more that these markets are allowed to flourish, we will see more and more innovation outside of the markets by being able to use them. And then finally, on the states issue, very important on the topic of consumer protection, because if you look at how the states regulate these markets or any type of related market, these are not, the customer protection is not the first and foremost thing. They are allowing these companies, particularly the sports betting companies, they are exploiting losers, they are banning winners, they are not treating this in the same way as a properly operated financial market. And so I think that's a very clear distinction. And so I'm glad to see the CFTC is taking that on. And it's extremely important to have this principles-based approach to protect and serve not only the market participants, but also the general public and the public interest. So thank you.
Thank you, Harry. I want to give Luana a chance to quickly respond, and then I'm going to go to Vlad and Brian next.
Yeah, no, thank you. I just wanted to respond since Kaushi was called by name here. I would actually like to ask, Terry, has CME never had any issues with, any market manipulation, any issues ever in its history?
If you'd like to have a debate, I'm happy to have a debate with you. There's always
No, I'm just asking a simple yes no question. Have you guys had an issue with market surveillance?
I have more people in my regulatory department than you do in your entire company, okay? Thank you.
Maybe you should learn a bit about efficiency then.
Well, maybe you should learn about credible markets.
Okay. Well, let's try to keep this productive. Okay.
Yeah, I mean, I think every market has risk, and every nascent market will have risks as well. And they're having issues in every single traditional market, in every single exchange here, onshore and offshore. And I think the point of having regulation is that you find these issues, you address these issues, and there's a way to address them in a correct way. And one point to make on prediction markets. One of the reasons prediction markets have grown this much is because it has looked into events and things that a lot of the traditional industry has ignored. A lot of industries that need hedging and price basing. And a lot of the markets that the traditional industry looks at and thinks it's too small or thinks it's irrelevant is actually very important. We have actually a study coming out very soon from Kaushi Research that talks about the relevance of mainstream markets on how, for example, different words that Trump says move the S&P in a very dramatic way. And we have that coming out, and we have a lot of other studies there. And same thing goes for the Federal Reserve. And same thing goes to local and very state-specific local markets that we're happy to bring to market because we are able to list markets very fast. And again, with a robust regulatory framework, we're able to work with that. On the CFTC and SEC point, I think that I just wanted to address that a lot of great products fall in between. And there should be a path, as we talked about in the crypto part of the conversation, there should be a path for regulation and innovation on both sides. And self-certification, especially for prediction markets, is extremely important because a lot of prediction markets, again, and the price basing that comes from these markets come from the news and something that happens, that we need to be able to have these markets fast for our users. And it's important that, when we think about where certain markets land, we think about the end consumer and what's best for them and what's safer for them, and then backtrack from there on how to make these things work. But thank you so much.
Thank you, Luana. Obviously, we're at time, but we're going to keep going, and I want to make sure everybody gets a chance to comment. But if we could try to wrap this up in 15 minutes, let's start with Vlad.
I'll be very quick. Thank you. First off, it's clear that customers love this new ability to trade prediction markets and to own economically the outcomes of real world events. I think I'm probably not unique in saying this. We believe the CFTC is the correct regulator for these. We appreciate all the support and you guys actually going to bat and agreeing with this publicly. And a lot of the criticism, no doubt, from the states and other actors are folks that have a financial interest in the opposite rather than a principled interest. And as some others have mentioned, principled arguments about, a federal framework not being sufficient for surveillance or customer protection just doesn't make sense on its face. And I think that if we continue to iterate on this asset class, it's not just going to be a good trading product, but it's going to be a truth engine, a truth machine that'll make it easier and clearer for people to make important decisions. A couple of things that have come up or that are maybe less duplicative. One is on mention markets. I have mixed feelings about mention markets. So on the one hand, I agree that they can be very fun. On the other hand, certain mention markets, I think, are very prone to manipulation. And I don't think that it's necessarily even conscious or intentional, but if it's, someone giving a informal speech, you'll just see people at these events saying, hey, say this, say that, or, you never really know whether you're giving someone a thumbs up because they have a financial interest in the outcome or whether it's something more innocent. So I think it's just something to watch over. I think that the line, it doesn't feel like we have the right line in how we think about things like mention markets, and certain ones that I've seen I think are very prone to manipulation, and there's just a customer protection issue that that raises, although I do admit that they're very fun. So it's something to look at a little bit more carefully. I think the other one is on the disparity between direct to DCM and FCM intermediated retail access when it comes to KYC. I talk to customers from time to time, right? And I was at dinner in DC, and I caught some conversations about prediction markets, and I was like, oh, why do you use this one? Why do you use this other one? And one of the things that struck me is some people actually prefer to use direct DCM models because they don't collect their employer information. And, various reasons for that, of course, and it's not always that someone's intending to do insider trading. Sometimes they just don't like their information being collected, right? And having this idea that the employer knows what you're doing if you're a customer might raise some questions. It provides some friction. So I think my point there is really that it doesn't really make sense for there to be two different models for retail access. I think that whether you're going through a DCM directly and you're a retail customer versus an FCM, we should make sure that we uphold strong customer protection. And my preference would be for the FCM model to be widespread. I think it just makes sense to have more information, and the friction is probably sensible in that case. But regardless, there shouldn't be this implicit arbitrage. And whether you're a retail customer coming from an FCM versus direct to DCM, I think KYC requirements should be uniform.
Thank you, Vlad.
Thank you.
Brian.
Yeah, so just a couple comments on prediction markets. The first is that, the federal law is unambiguous here, that the CFTC has exclusive jurisdiction. Congress has said so explicitly, and we really appreciate you defending that territory from, even in the face of litigation. I think it's a great counterweight to what we heard earlier about the 50-state regime and the crypto markets. Here we have federal preemption already in statute, and I just want to thank you for enforcing that. The second was this, prediction markets I do think are creating a genuine public good. And Walt, this gets to your question about, is it complementary to futures or unnecessary? And I think I think it's very complementary. The reason is that it helps people understand what's true in the world in a way that's really difficult to get from other sources. The breadth of the markets is important here. It's really kind of becoming an alternative, I think, to traditional media and social media, because traditional media comes with its own biases, and you're often reading not what is actually going to become true in the world. You're reading what someone wants to become true in the world, and they're pitching you with their own biases. Same thing on social media. So that's very important. There was part of the prompt here was about what principles should govern the listing of novel contracts, and I just wanted to put forth a concrete proposal to advance the conversation. And so first of all, I think just because something is novel, that doesn't mean that's not a good reason to reject it, right? And so I was trying to think of a 3-point test, and what I came up with was the first test would be, does it create public harm? Now, of course, you could say, does it create a public good or public benefit? But I actually think we should be in a default allow it to happen unless we can point to a specific harm. Somebody might say that, oh, that market it's frivolous, or who knows what it's for, but somebody might be deriving benefit out of it in a way that we didn't contemplate. So unless we can point to a specific public harm, I would default to listing, in my view. The second point would be, the market would have to have a direct causal link to that harm, right? And so, the example here would be like an assassination market or something like that. But if the market was, when will the Ayatollah Khomeini be out of office? There's a variety of ways someone could come out of office. And, I think you could have a second order effect, a third order effect. You can tie yourselves into knots with this, unless I think you should hold the bar at there has to be a direct causal link. If you don't enforce that, almost anything could have an indirect link. Imagine any of us stepping down as CEO and the stock price fell that day. So if you're going to go to that extreme of saying there can't be any second or third order effect of harm, then we wouldn't even have public stock markets, right? In some ways, the public stock markets are already a prediction market on a CEO stepping down or something like that. And then the third part of the test would be this question of how subject to manipulation is it? And I think it is dangerous to have something that could be decided by one person. But we have to be careful not to go too far with this, because there could be examples where the public good outweighs the risk of it being subject to manipulation by one person. It really comes down to like a resourcing question of, can the CFTC appropriately enforce? You could say our stock markets are subject to manipulation, but we have an agency that enforces that and investigates it and gets tips. And as long as a good example would be, President Trump making a comment about the tariffs in Canada. That's a mention market. It's by one person. One could say it's even subject to manipulation, but to me, the public good of that outweighs the downside. So that's the idea that I wanted to put out there of, does it have public harm? Is there a direct causal link to that harm? And how subject to manipulation is it?
Very helpful. Thank you, Brian. I think I have Don next on the list.
Yeah, so I'll be brief. I mean, just a couple of high-level thoughts. Obviously, a Brexit contract would have been incredibly useful. Will the Fed hike or not? That's an example of something that's a very useful contract. Obviously, you can also trade Fed funds futures. I haven't seen any evidence that volume in Fed funds futures has declined because of the existence of a will the Fed hike contract. So I think that they're complementary. I think that some people prefer the simplicity and ease of a prediction market around the Fed. Now, I think we can, and Brian, I like your kind of proposal around a framework of this kind of three-pronged framework. And there are clearly some markets that just don't meet that bar that have been listed. I mean, nice job to the CFTC and to Kalshi working together on this, George Santos situation. But the question of will George Santos attend the State of the Union address, I don't think that that was really all that important to anybody. And it was obviously readily subject to manipulation by one person with, kind of no, I mean, whether he went or not was not going to have any impact on his life, really. And of course, he took advantage of that. So a good outcome in policing that, but I would argue that never should have been listed in the first place. And I think there are a bunch of other things in that category that just don't meet the bar and just should not be listed. And I think that it's in everybody's benefit in this room that we cut that bottom tier of things out, so that the important things like Brexit and Fed hike can thrive and grow. Thank you.
Thank you, Don. Jason, is it Jason at the very, yeah.
Hello. First, thank you to the chairman for, I think everybody said this, but I would be remiss not to pile on. The constructive, collaborative approach you've taken, I think, is an example of how government and industry should interact to everybody, and really just can't thank you enough and can't tell you how much I appreciate it, having seen many examples of the opposite, as I know everybody in this room has over the course of their time in their jobs. So thank you for that. I just want to make 2 quick points. One, I want to add or really agree with what Vlad was saying, that the rules for customers going directly to DCM versus those going through an FCM should be identical. There really is no distinction from the consumer protection perspective, so that absolutely should be the case. The second point I want to make is more of a message for everybody in the room. I know that this is a very sensitive topic. I also know all of you have experienced regulated industry for a long time, and those who have, I'm sure, have seen infighting get in the way of constructive dialogue and solutions-oriented discussions. So I would just ask everybody, both in this hearing and then also in future communications, to try to refrain from taking shots at each other's business models or decisions that you may not 100% agree with. That doesn't advance the discussion. All it does is sow divisions and distract the discussion towards debates that really aren't productive. So that's something I think all of us should take away. And I certainly have opinions, as all of you do, and there's a time and a place for it. So I think we all should make sure that we are doing that in an appropriate manner and trying to actually get things to the right people who are trying to set up these hearings to facilitate constructive dialogue so that they can do their job and get policy right. So thank you for all that.
Thank you, Jason. Prudent advice. Matt.
I will not fully reiterate Jason's sentiment, but as a new participant to this industry, I really appreciate the spirit of welcomeness and collaboration that we've experienced coming into this industry. There are a lot of issues in this room that I don't fully appreciate because I am new here. I'd say the one issue, and the one thing I know very well, is retail. I've been working with retail consumers for a long time, and I would just underscore the importance of getting a principles-based approach to consumer protection and responsible trading nailed as part of all this work. While a vast majority of customers will use these products for profit or for fun, there is a small chunk of them that will have a problem using them. And I think it's really important that we set minimum standards for all operators in the industry in order to ensure that, one, we protect customers, but two, you ultimately avoid the backlash that would be inevitable from a lot of negative stories coming out where people have used any of the platforms in this room or in this industry to their own financial harm. And I think we have an amazing opportunity because of the leadership in this room to take a leadership position around the issue and set super clear standards from day one from a proactive perspective. And that's very unique.
Thank you very much. We haven't heard from Tom Farley, so I want to jump the line here a bit. Tom?
Thanks, Walt. Tom Farley, Bullish. First time I was in one of these confabs was in this room circa 2008 with Chair Walt Lucan presiding. But thanks, Chair Seelig and Mike and Amir. I just want to say of all these I've been to, CFTC, SEC, over the last couple decades, the the firepower in this one is unmatched, and this has been a really valuable session. And thanks for all that you're doing for the broader industry as well. I've told you privately how much I appreciate it. I'll say it publicly. Two quick thoughts. One, Walt, in providing some context, asked the question, is this a zero-sum game? You add some new products, I don't know, prediction markets or what have you. Is that generally good, or is it just subtract from something else? It's always good. Like when I look back, there was hand-wringing about electronic trading. There was hand-wringing about, I'm sure, equity indices. There was hand-wringing about basically every single innovation that we've all been a part. And you look back and they all added to the GDP growth. They added to risk-adjusted GDP growth. They added to this great free enterprise engine that we're a part of. So I would just say, please keep this stance of tending towards innovation and being willing to accept a little risk, knowing full well we're going to make some mistakes, like the example of the Santos mistake. I'm sure everybody was, okay, yeah, it was a mistake. You're going to get some of that, but you're getting this incredible innovation, including from Kalshi in particular. And by the way, thanks Terry and Luana for spicing it up after 3 hours. That was helpful. I'm wide awake. And then the last thing I'll say is that somebody mentioned this VPN thing. The VPN thing's a real issue, and what I mean by that is there's a playbook to getting access to the U.S. markets if you're overseas. I start overseas, and I get a whole big U.S. following because they're spending 30 seconds downloading a VPN, and they're logging on supposedly from Turkey, but it's the U.S. What I've seen in crypto, and I've been in and around it now since 2013, when things are successful and they have a lot of volume and a lot of customers, they have somewhere between a lot and tons of U.S. customers, even though they don't have access to the U.S. So we can ignore this VPN issue, but then that means that playbook will exist where firms will just get big overseas, they'll tap the U.S. market illegally, and then they'll come to you and they'll apply and they'll say, oh, look, we're good people, we have no U.S. customers, don't pay attention to any of this VPN business. So that's what's going on, and I think it's worth a look. Thanks again.
Thank you, Tom. Shane, turn to you.
Well, I was actually going to talk about surveillance of prediction markets. Back to what Terry was saying, and I think other people have mentioned, you look at these new asset classes, you kind of see you go and see the life cycle of a new technology or a new market, and I think like it's not going to be right from the get-go. And it's put, I think, more eloquently by Tom. But so it's you kind of got to think about like throwing the baby out with the bathwater. It is most definitely an experimental phase right now, where it's like, okay, these things were an idea, as a lot of people have mentioned. They've been an idea for a really long time. A lot of people have attempted to build them. Prediction markets. There's been some academic research from some even folks in this room dating back over a decade that are like very poignant and prescient in terms of how we think about prediction markets today. The fundamental premise is if you can go and apply the magic of price formation and price discovery to important current events, you go and give everyone just an easy way to say, hey, well, what are the odds? Or how likely is this to happen? Or there's no shot. You can go and extend that with markets to reality. I think people have found that immensely important. It was really the sort of core kernel insight that led me to build Polymarket. And when we think about these, like the Maduro thing and whatnot, and these things around the edges, like, yeah, those are problems. When that happened, like we worked with the commission, we worked with law enforcement. We have someone here right now who is ex-FBI, who works full-time at Polymarket, has built custom proprietary surveillance software on chain. I know this is live stream, so people are going to be upset to hear that, but we talk with our partners, Palantir, Chainalysis, and they're like, damn, you guys have this in-house? This is serious. And we're grateful to have that, and we continue to invest more in it. So, I think that, like people have said, there's always throwing stones when something new comes along, especially when the dollars get involved. When people say, oh, these young people are getting so rich, and it's kind of like this fixation and sensation, kind of sensationalizing it. But this stuff has taken a long time to get here. There's been, I give a lot of credit and gratitude for a lot of the people who've paved the way. A lot of credit to Kalshi for going and fighting the battle, in the U.S. to go and sue for what's right and win. And a lot of us have been beneficiaries of that. A large portion of us in here. I think that this big facet of, oh, people talk about Polymarket, they talk about Polymarket International, the DeFi version, because, we have a US regulated DCM, DCO, but a lot, there's all this stuff like anonymized and like, insider trading. First of all, it's not anonymous. It's all public, it's all on chain. It's the least anonymous financial market of all time. You can look at every single market and see every single trade and look at the trading history in full of every single participant. Like it's, a level of transparency that's unprecedented. And with that, it actually brings a whole new set of data and insights that you can go and glean from when you look at any market to go and find anomaly detection. I think that that's what we've been investing in. And the point is, when you're on the fringe and you're building something new and you're innovating, as things pop up, you have to deal with problems that come appropriately and diligently and seriously, and you have to engage. And I think the most important thing is, no one I think is here saying, hey, we don't want to be held accountable for mistakes or missteps, but when there's collaboration between public and private sector, when there is innovation and there are things that are not gotten perfect or there are problems, like you can be so much more productive in bringing new markets, but also like maintaining American dominance. So, grateful for that. And definitely by no means, I'm sure I speak for, all the younger companies here, like by no means coming here and saying, hey, everything's perfect, we've got it all figured out. I'm sure we have a lot to learn from all the seasoned operators in here, but we are doing our best, and we think that the pros far outweigh the cons.
Thank you, Shane. And we have to wrap up here. But Christian, we haven't heard from you. If you can wrap up in a minute, and then I'm going to turn it over to the chairman for some closing remarks.
Yeah, you can put me on the clock. First of all, thank you, Chairman, and we really appreciate. I'm from FanDuel. We appreciate our inclusion in this group and the fostering of transparency and open dialogue in this session and beyond. We're a relative newcomer to the space. I think our perspective is that the most critical thing we can do for prediction markets right now is to build consumer trust, and that the way to do that is to have clear rules of the road and a level playing field for all the participants. And so, to that end, we really appreciate the rulemakings and the more public comment, and we encourage more of that, and we're happy to be a participant in the dialogue around consumer protection, market integrity, advertising, and all the issues that we think will build that consumer trust. Thank you.
Well, thank you. That wraps up our session. I think we can all be in agreement that nobody wants contracts to be able to be manipulated in our markets. To your point on trust, that is to the detriment of everybody, and especially the CFTC. So just to make that point abundantly clear, but let me turn it over to the chairman to give some closing remarks.
Wow, this was such an incredible session. I learned so much. I think we all, I'm sure, learned a ton from everyone in this room, and it's incredible to see all of the development that's happening here in the United States. I think you all should pat yourselves on the back for being here in this country, fighting the fight against everything that you've seen in the past, and a lot of you still today with many of these state actors. To me, the takeaway from this conversation really is that we've been here before. A lot of these challenges aren't new. It's the first time I'm hearing Reg AT in a long time, and that source code provision I know was really a challenging one. So glad we're not collecting source code here at the CFTC, especially when we're talking about honeypots earlier. But I think what's really important is that we've learned so much from all of these challenges that we faced, both at the agency and in the private sector, whether it was fighting against these anti-gaming and anti-bucket shop laws back in the 30s, or fighting Chris Christie and Letitia James today. We're seeing a lot of parallels. We saw it with crypto, where you had a 50-state patchwork and the bit license, and you're going to the Bahamas and offshore to build your projects, and that really was not beneficial to anyone in the country or to any of the projects that had to take those risks. I mean, I don't know how many millions and millions or hundreds of millions of dollars were spent on legal fees. I'm sure everyone can compare notes in the room, but it wasn't good for the country. And we've really tried to turn the page. We're still working to protect our jurisdiction. We're working to get the Clarity Act across the line to expand upon that, protect that even further. And I think that's something hopefully everyone takes away here, that we're working with Congress to get more protections, more preemptions, so that you're not dealing with the same sorts of things you're dealing with in the prediction markets and that you've dealt with in crypto. And we've got to make sure we win in court, because if we get judges that overturn some of this stuff, it's really problematic. So I think it's great to have everyone in this room working together. I want to thank Walt, Michael, Amir, and everyone who's organized this meeting. It really has been a productive one. And so thank you all for taking the time to be here and for your service. And I hope everyone takes away some really great thoughts on how to approach regulation and help work with us at the commission to get things right.
Thank you, Chairman Seelig. I'm sorry. And to our MC and Chair of the IAC, Walt Lucan. I also want to thank everyone for attending and participating in the inaugural meeting. I must also add that to the extent you would like to submit written comments in connection with this meeting, you can do so electronically via the CFTC's website until August 27th, 1 week from today. And so thank you again, and the meeting is adjourned.
Okay.